And here are your top stories. Mixed signals. The yuan fluctuates as China accelerates the easing of COVID restrictions, returning the focus to growth, but trade slumps. Sound the alarm. US stocks slide as banks warn about the gloomy outlook. Goldman Sachs CEO David Solomon says job cuts and smaller bonuses may be on the table. Plus, Georgia on my mind. Senator Raphael Warnock defeats Republican Herschel Walker in their hotly contested runoff, giving Democrats an outright majority in the upper chamber.
Tom, if we take a look at the futures, they're for the moment trading sideways. Certainly the FTSE 100 futures are pretty much unchanged, and then you have DAX futures down 0.5%. Again, questions, many question marks about China, and then worries about the global economy.
Yep, European stocks down for 3 days. We'll see if that changes today. US stocks off for 4 straight days, and mixed messages out of China. Then, yes, I think after all of the speculation, after all of the rumors, after the incremental changes, today we have finally got confirmation from the top that there is a pivot on COVID zero. So that is consequential, but the trade data was very weak indeed, particularly exports, such an important pillar of growth for China in the last few years, and surprising as you lead out to that holiday season. Currently, across the European markets then, opening lower, the FTSE 100 down by 14 points, off by 0.2%. Over in Spain, losses of 0.2 as well, off by 18 points. Interesting, a Bloomberg survey, including the likes of Goldman Sachs and Bank of America, suggesting that you're going to get gains of no more than 2% on the benchmark European Stock 600 by the end of 2023. Let's switch it over and see how things are playing out cross-asset then. As you talk about 4 straight days of losses in the US and that drumbeat of doldrums from the CEOs of some of the big banks there, including Morgan Stanley, JP Morgan, and of course, David Solomon of Goldman Sachs, on recession concerns, on job cuts, and on softer bonuses as well. The futures currently range-bound in the US. Wanted to point out what's happening over in Hong Kong, because of course, after the rallies that we've seen, a bit of profit-taking, it seems. How much was priced in terms of the reopening into some of these stocks listed over in Hong Kong, because it's currently down on the benchmark there, 3%. Euro dollar 104, softer by 0.1%, reflecting a bit of strength coming through for the US dollar. And Brent, $79 a barrel, look at that. Just a gain of 0.1%, back below $80 a barrel, and in fact now flat for the year. Francine.
If you dig a little deeper into the sectors, Tom, this is what you're seeing. So it's basic resources, really, where we're seeing quite a lot of pressure. Look at that. This is the power of the Bloomberg terminal. You can click and you can see, for example, the total return from the start of the year on packaged food and meats. Apart from the Bloomberg terminal, where else do you get that? So it is energy and basic resources down between 1 and 1.2%. I'm only seeing 3 industries actually on the upside, but again, it's not huge. They're pretty much flat. It's utilities and healthcare. Again, it's concerns about inflation, concerns about the economy, especially as we start getting those 2023 projections. Now, let's bring in Bloomberg's markets reporter, Valerie Taitel, who's looking, Valerie, good morning, today at China's trade data.
Hey, Francine, good morning to you. I specifically want to point out the big miss in China exports. Now, this is the 2nd month in a row it's come in weaker than expected, and it is falling year on year. Now, this means 2 things. For China, it means that they cannot rely on global demand in order to boost their economy, which we know has also been slowing. They're going to, maybe instead this increases their urgency to reopen in order to support internal demand and to support their economy that way. And then for the U.S., maybe this string of strong data we've got recently is about to fall off the cliff. Export demand from China is a really good clue in to global demand, and it has been falling. Now, I want to look at one other thing. Now, a lot of hard landing skeptics would probably say, yes, the China trade data, fine, it's falling. There were lockdowns, though, in October and November. We know that's clearly turning a corner. But if you look at my BTV, I'd like to point out one other thing. China shipping rates have fallen off a cliff. Not only that, they've retraced 50% since the summer. That is clearly pointing that there is more goods disinflation coming in the U.S. We have U.S. PPI on Friday ahead of the CPI print next week, well ahead of the Fed meeting on the 15th. And perhaps maybe this drag on goods disinflation, maybe perhaps that will be what the attention will be grabbed on next week's print.
Yeah, really, really interesting. Two things jumping out for me from that, Valerie, the breakdown of the trade data out of China then, that disinflationary impact maybe from shipping and, of course, what you're saying in terms of demand for Chinese exports, but then just the story around China reopening, potentially in a recessionary environment, the timing then, the implications for the government of China. Thank you, as ever, Bloomberg Markets reporter Valerie Teitel breaking down that important trade data out of the world's second largest economy. Now, China is set to announce further easing of COVID measures as soon as today. In fact, those announcements have come. It comes as the country's exports and imports both contracted, as Valerie is pointing out for us, in November, as external demand continued to weaken and a worsening COVID outbreak disrupted production and cut demand at home. For more, we are joined by Bloomberg's chief Asia economics correspondent, Enda Curran. Enda, the detail on these steps being announced coming through from this Politburo meeting, we've heard the rumors, now it seems to be being solidified. This is a pivot on COVID zero.
It is a pivot, and it's a very fast-moving story as well, Tom. 10 points come out of the central government today, like you mentioned. They include a range of measures, such as if you get the disease, you're allowed to quarantine at home now rather than go to a government facility. There will be less restrictions in terms of putting blocks of flats under lockdown. That was one of the main components of the playbook. There will be less requirements on testing to enter public spaces, and they'll try and get the vaccination rate going again, especially among the elderly. So they're definitely making a big push on that front. It's being interpreted by analysts as a clear step away from COVID zero. Now, it must be said they still have a lot of restrictions in place in China. There's still a long way to go in this road. There's not least, of course, the question mark over how they navigate this without a major public health crisis. But nonetheless, the takeaway today, and in recent days, in fact, has been that China is pivoting away from COVID zero. It seems to be accelerating that pivot now. It's something of an open question of just how fast that becomes over the coming weeks and months ahead.
So, Enda, what are the top lines? Of course, I mean, on the trade, so Valerie Teitel was bringing, some of the data. What does it mean for 2023?
I think it clearly speaks to another soft spot or weak spot in China's economy. A lot of people are saying this pivot on COVID zero is being driven by economic weakness now. Trade had been a good story, of course, as we all know, but here we're seeing exports falling by the most since the pandemic began. That's more of a global story than a China story, but the end result is that it will hit the manufacturers and profits and, of course, hit their employment intentions. Imports are weak in China because, of course, consumers, as we know, are tied up in knots due to the COVID zero regulations. But the net takeaway is that China is the world's biggest trading nation. That side of things are in the doldrums. We did have a message from the Politburo that the central bank is going to be out with more powerful and targeted support for those parts of the economy that needs it. So still a disciplined message, not kind of wholesale stimulus, but they are certainly coming with support for the economy. And a lot of people are saying, look, this move away from COVID zero, there's news of more support coming from the central bank. It all points to something of a floor, at least, under the economy heading into next year.
Enda, thank you so much. Enda Curran there with the very latest. Of course, on China, we're also now joined by Wisdom Tree Director of Research, Annika Gupta. Annika, good morning. Thank you so much for joining us. As we look into 2023 and beyond, are you confident that China's reopening will be, first of all, will be consistent and that this is definitely the path forward?
A very good morning to you. It's the million-dollar question for us and for global markets, because China has always been that very important pillar of support for global economic growth. And clearly we've been vouching for that right across 2022, and it never really happened. But these widespread protests that we have seen over the past few weeks are now clearly resulting in a change or a pivot in that zero COVID policy. And I think it seems to be moving in the right direction. And I think, today's trade data clearly does point in that direction. You're seeing an important support factor for the Chinese growth now beginning to falter as the rest of the world starts to see these rolling rates of recession seep in, and hence China knows that if it needs to rejuvenate that growth, it will have to happen from within. And so locking up the economy would not be the solution. So I think we're going to see more impulse. Policy support coming in for the property sector, which accounts for nearly 30% of GDP. And we're also going to start seeing a bit more flexibility on zero COVID policy, which should help, bring back some of that support for retail sales growth.
Okay, Anika, I'm just going to jump in quickly because we have a redhead crossing the terminal, separate to the China conversation. This is GSK. We'll get back to China and your view on the markets shortly, Anika. But GSK, just for our viewers, soaring close to 14%. This is on the back of a court win in the US. So a federal judge throwing out a claim by around 5,000 individuals around the Zantac heartburn drug that GSK and others produce. The claim was that it was linked to cancer. This federal judge has thrown that out. Interesting that Morgan Stanley had previously crunched numbers and suggested the litigation could cost these companies around 45 billion US dollars. So GSK jumping, as you can see, a little over 13% on the back of that news. Anika, coming back to the China story then, the question is how you get exposure. If the estimates are, the assumption is you're going to get policy support coming through precisely because you said the data is coming in weak on the economy, and then that combines with a reopened economy over stages. We spoke to Goldman Sachs yesterday, Sharon Bells, who says maybe you buy the FTSE 100, maybe you get a slice of European companies with sales exposure to China. How would you play the reopening?
Well, if you just in today's trade data, if you look a bit closely, you see that the trend in oil imports has been quite strong. So we saw both crude and refined oil product growing by 11.8% and 19.9% respectively. So that reflects that oil refiners and traders are anticipating stronger demand, on the back of policy-supported auto sales at home, as well as, China capitalizing on access to Russian oil. I think another exceptional area of growth was in copper ore and concentrate. So we saw that increase year over year in most months since 2021. And that clearly is supporting power grid and other infrastructure investment. So I think I would look at it I would take the tilt of looking at those commodities that are likely to benefit by this China reopening story. So oil is one of them. We've seen oil from its peak fall around 30% this year. And I think there's plenty of catalysts that are now, bringing about a lot of change in the oil market, beginning with the EU embargo on oil, the oil price cap. So I think that should lend a strong tailwind alongside now China, taking a pivot on its policy.
But Anika, do you worry that if China reopens too quickly, or actually reopens fully, there's going to be such strong demand for oil that oil price will jump to 100, if not beyond, and that will be the final straw to push the world into a recession?
Well, it will be a very strong balancing act. And what we're really seeing right now is, a dislocation. So we're looking at EU trying to find alternative suppliers. We're observing Russia trying to find alternative buyers. And so within this, you're going to see a lot of change in, the export and import flow taking place. Now, obviously, with China beginning to reopen, that is something we've been anticipating since the start of 2022. And that would definitely have a big change in how we'd see the trajectory for oil prices going forward. But at the end of the day, we also need to keep in mind that, we do have OPEC on one end that has at its most recent meeting, kept the decision on hold after, quite an aggressive cut of more than 2 million barrels per day. And clearly, if we are going to see a noticeable increase in demand, I would expect them to call an extraordinary meeting, in between, because obviously their next meeting is coming up in April, to try and, keep oil prices within an acceptable range, which would not tip the economy, the global economy, into recession.
And Anika, in terms of your balancing, how you're balancing the portfolio, your exposure to equities, we had a Bloomberg survey of strategists. Their estimates the aggregate is you're going to get just 2% gains, 449 on the benchmark European Stock 600 by the end of 2023. Those strategies including Goldman Sachs, Bank of America. What you're switching from underweight to equal weight on European stocks. What is the rationale there?
Yeah. So two things. Over this quarter, we've seen an aggressive outperformance of cyclicals versus defensives within the European market. We do think that's quite excessive, given the fact that, for one, they're lagging EPS growth revision estimates. The second point is we typically tend to see European cyclicals move in lockstep with US cyclicals, and they've clearly gotten ahead of themselves. What we expect to see in 2023 is more of a rotation in line with EPS estimates. So we expect that value tilt to really factor in, bringing back, the ECB's involvement in monetary policy. We've heard the ECB continue to maintain quite a hawkish stance, but we don't think that's going to be. We don't think that they're likely going to be able to continue that beyond the middle of 2023. So that's where we'd see a pause and a very long pause take place. So hence that, again, favors and tilt of those more value-linked sectors, and that should have a considerable outperformance. I mean, we've heard the ECB themselves say that the recession is going to be a lot more shallow than we've previously anticipated. We've seen PMI numbers, the ZOO survey, all fall in line, and the improvement in consumer confidence all fall in line with the fact that the recession in Europe is going to be a lot more shallower than previously anticipated. So we would expect,
Yeah, Anika, we're running short of time, but we do really appreciate your insights, making the case there for the tilt to value within the equity space. Again, Anika Gupta, Wisdom Tree Director of Research, thank you for joining us and for those insights. Coming up, bumpy times ahead, Wall Street bank chiefs, well, they're warning of a looming US recession. We'll get more on that next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
competition for talent is still very, very strong.
We think it's a really strong market and are seeing growth in employment.
We're still hiring new relationship managers in business banking, commercial banking, new financial advisors, private bankers.
While there's a lot of noise about the economy, we really feel good about what we're seeing.
We have some bumpy times ahead.
The U.S. consumer is still holding up really well.
The spending by the consumers of Bank of America is up over last year.
If we head into a sustained recession, and I think we will go into a recession next year in the U.S.
We could see a recession in 2023 also.
If we have to make tough decisions, which I think we might, we will do that.
I think you've got to be cautious and prepare.
Executives speaking at the Goldman Sachs U.S. Financial Services Conference in New York. Now, you heard Goldman Sachs' chief executive, David Solomon, warning of bumpy times ahead for the global economy. That sentiment, of course, echoed amongst other major U.S. banks. Morgan Stanley plans to cut 1,600 employees. Bank of America says it's also going to slow hiring. Joining us now is Tom Metcalf, who oversees all of our finance coverage in Europe. So, Tom, first of all, the mood in Wall Street, frankly, could not be worse, or at least we didn't know 6 months ago that it would be this bad.
Yeah, it's definitely pretty grim tidings from a lot of those sort of big Wall Street names. So, you know, Solomon, as ever, stood out. He was pretty frank, saying, look, we're going to expect more cuts, don't expect big bonuses. And then, of course, that news from Morgan Stanley about those 1,600 job cuts. You know, that is a complete sort of reversal from what we've seen in 2021, where banks were falling over themselves to hire. So, you know, I really think the mood has shifted.
It was interesting, particularly from David Solomon, given that his own team expects still a 35% chance of recession in terms of the last report I saw on that estimate. But he thinks it's pretty much baked in. In terms of, and we heard it there from Alliance Bernstein as well, the recession concerns leading into those job cuts, and we talked to you about this before, it's not the end in terms of the layoffs, it seems.
No, I don't think so. I think, you know, the messaging is clearly this is going forward. 2023 is looking grim. And, you know, the Bank of America message was particularly nuanced and interesting, saying, no, we're not cutting jobs, but look, we're trying to get ahead of this. We're trying to manage our headcount. But yeah, read between the lines, you suspect you're going to see some cuts.
So in terms of 2023, are we worried about the markets impacted by the economy, or is it more underlying liquidity concerns?
Yeah, I think recession is sort of on everyone's lips, right? And, you know, if you're in the UK, you kind of feel like you're already there. But globally speaking, that seems to be what's happening. A few analysts were basically saying, in terms of time frame, expecting it to be pretty sort of volatile for the next few months until this gets priced in. So sort of the early next year will probably still be pretty painful, and then maybe we'll have bottomed out by that point.
Okay, so that is the look ahead as we weigh up the pressure on the banking sector. So much for higher interest rates, proving a buffer. It's investment banking that's really come under strain, hasn't it? Tom Metcalf, who covers all of this for us, on the back of those comments from a number of CEOs, Wall Street CEOs yesterday. Again, as Tom was saying, recession on everyone's lips. Coming up, we're going to take a look at some of your movers, including Big Pharma. Yes, GSK and Sanofi surging after that US court win around a heartburn drug. We're going to bring you the details. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, of the US, Europe and the UK, have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
No No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to the Open, everyone. 23 minutes into the European trading day. A lot of question marks about China. Stocks slipping overall, dollar gaining. Again, mixed signals with China. And of course, questions over 2023, the economic outlook. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. GSK and Sanofi shares have risen sharply after a US federal judge rejected the scientific evidence behind more than 5,000 lawsuits claiming heartburn drug Zantac can cause cancer. UK-based GSK welcomed the ruling and says it will continue to defend itself vigorously, including against all claims brought at the state level in the US. It's reported that privacy regulators at the EU will rule that Facebook owner Meta shouldn't require users to agree to personalize ads based on their online activity. Such a ruling could limit the data the company can access to sell targeted adverts. Meta shares have fallen by about 2/3 this year. Apple is said to have scaled back self-driving plans for its forthcoming electric vehicle and postponed the car's target launch by about a year to 2026. Sources tell Bloomberg a fully autonomous vehicle isn't feasible with current technology. Apple is now planning a less ambitious design for use only on highways. That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins, thank you very much indeed. I'm going to pick up on one of the stories that Alice mentioned because it's a loss for the claimants, but it's a big win for Big Pharma. GSK in particular, as Alice was saying, one of the companies associated with this claim that's been thrown out by a federal judge in the USK. GSK, Sanofi, Pfizer, amongst those who have now seen that court win in the United States. The claims were that their heartburn drug Zantac can cause cancer. Again, that has been thrown out by a federal judge. And interestingly, Morgan Stanley, they've done some estimates around the total damages from this litigation, 5,000 lawsuits, and that number could have come to $45 billion US, according to the analysis by Morgan Stanley. They're not completely out of the woods. It is a big win, but there are other cases in court, particularly around the state level. So we'll see what happens there. But at least for now, a big win for the likes of GSK and a huge move higher, 13%, one of the biggest moves that we've seen in almost 2 decades. Sanofi, of course, also gaining 8%. And Taylor Wimpey, this is around the housing story. We had some Halifax data, a 2.3% drop in house prices here in the UK. That's the 3rd straight month. That is the biggest drop in 14 years. Taylor Wimpey, one of the big builders of homes, of course, across the UK, just down 0.8% as investors weigh up the pressure on the housing market here in the UK. Okay, coming up, just peachy for the Democrats. Raphael Warnock defeats Republican Herschel Walker in their hotly contested runoff for Georgia's Senate seat, securing the party a majority in the chamber. Interestingly as well, his backer, President Trump, seeing his companies lose a legal fight as well. So implications for the former President Trump. So we'll see how this plays out in terms of the politics of the US and get the analysis and the deep dive. The markets here in Europe, the benchmark currently down 0.2%, range bound on your S&P E-minis after 4 straight days of losses in the US. Stay with us. This is Bloomberg.
what do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open, everyone. 30 minutes into the European trading day, here are your top stories. Mixed signals, the yuan fluctuates. China accelerates the easing of COVID restrictions, returning the focus to growth. Trade, though, slumps. Sound the alarm. U.S. stocks slide as banks warn about the gloomy outlook. Goldman Sachs chief executive David Solomon says job cuts and smaller bonuses may be on the table. Plus, Big Pharma surges after a big win as a U.S. court dismisses cases against heartburn drug Zantac, while GSK jumps the most in 25 years. Tom, this is something that really actually caught your eye before the market opened. What else are you looking at?
Yeah, so we'll dive into that healthcare story and the GSK story just in the next couple of minutes. But we'll set up now for 4 straight days of losses across European equities. As you're saying, it's concerns, again, about recession being vocalized, of course, by those Wall Street giants in the US, of course, yesterday with the likes of Goldman Sachs and Solomon, suggesting there's going to be a bumpy ride ahead. And then there's the trade data out of China and exports. And this is the importance leading up to the holiday season, coming in lower once again, just suggesting that that pillar of support for the Chinese economy is starting to crumble. But when will the fiscal support come through for Chinese officials is important as well. And in terms of COVID zero, we've had the room, we've had the piecemeal incremental changes, and today you do have a concrete pivot from officials at the top around COVID zero. All of that, of course, playing into these markets. Currently, you're seeing losses across the benchmark of 0.2%. And if you're looking to next year, a Bloomberg survey of strategists suggests, including Goldman Sachs and Bank of America, that you're going to get just 2% upside from around current levels for the benchmark European index by the end of 2023. The DAX currently down 20 points, the FTSE 100 off, or I should say gaining 0.2%, the FTSE 100 up by 0.2. That is tied into the healthcare story. Let's switch it over and see just how much strength is coming through for that sector on the back of that court legal win for the likes of GSK. There it is, healthcare at the top of the list, 1.3%. You have retail, utilities, and autos as part of the mix, but this is a standout sector. And again, we'll get the details on that story just in the next couple of minutes. At the bottom of the list, basic resources, because you're seeing iron ore under pressure and oil as well. Oil now flat for the year. WTI well below $80 a barrel, but it's iron ore and copper off. Again, linking to that trade story out of China. Francine.
Yeah, so Tom, as you were saying, GSK and Sanofi are surging at the open. That's after a U.S. judge rejected the scientific evidence behind claims that heartburn drug Zantac can cause cancer, meaning the drug makers don't have to face more than 5,000 lawsuits. Now, joining us now is Joe Easton from our equities team. Joe, first of all, how much of a setback would it have been if the judge had allowed it, and does it mean for these pharma companies going forward?
Well, I think it's huge news positively for these companies, given the extent of the declines that we've seen since this lawsuit came about. And we saw also with Bayer a few years ago with the Roundup case how much of an effect that had in terms of the fines that they had to pay. So investors were really worried that GSK and also Haleon, the spin-off unit, and Sanofi over in France would have to pay big fines for this. And as such, we're seeing those huge gains that Tom mentioned there, with GSK heading for its biggest gain today in 20 years and really lifting the UK benchmark. And that's behind a lot of that outperformance that we're seeing today in London.
Joe, I want to do a little bit of a pivot, but stay and keep the focus on the FTSE 100, because we heard from Goldman Sachs yesterday, Sharon Bell, saying maybe the FTSE 100 is a way to play the China reopening story. Is that chiming with others that you're hearing in terms of how to position for this now pivot on COVID-0?
Yeah, and I think we've actually seen a bit of that today with the China data coming through, and we've seen a bit of a reversal of that kind of theme this morning, with some of the import data from China not as strong as some investors had hoped. So those commodity stocks have actually lost a bit of those gains today. But that's definitely been the theme over the past few weeks, that commodities and also the luxury stocks could do well given the China reopening story that you mentioned. So that could be a key driver for the FTSE 100, and also given its more, defensive nature, as some of the strategists that you mentioned in the previous piece are becoming a little bit less bullish on the overall global stocks outlook, the FTSE 100's defensive qualities could come into play again.
Yeah, really interesting. Despite the economic woes of this country, of course, we know that the FTSE 100 has that global component. Joe Easton, thank you very much indeed on hitting that healthcare story, the gains that we're seeing, significant gains across the healthcare sector, the likes of GSK and Sanofi on the back of that court win. Let's turn to the politics of the US now. This is a really important story as well. The results are in from Georgia, and Democrat Raphael Warnock has defeated Republican challenger Herschel Walker in the state's Senate runoff election. The win gives Biden's party an outright majority in the US upper house. Let's get more then from Bloomberg's Kriti Gupta. Kriti, just talk to us about the significance of this. The midterms, of course, a shock in terms of the results, but now the Democrats actually increasing their control of the Senate.
Yeah, a much better outcome than I think anyone really expected. Remember, this changes the game when it comes to how easy it is to actually make policy in the United States right now for the Democrats, or at least easier. Easy is an understatement, or overstatement, I should say there. What's important to keep in mind is the Senate majority here was 50-50. The tie-breaking vote would go to Vice President Kamala Harris. Now it's 51-49. So once again, just a little bit easier at a time and at a state, by the way, that has historically been mostly Republican. So this changes the game when it comes to things like healthcare regulation, with Raphael Warnock has been very out in front of. So keep an eye on things that he could really change. This also creates a precedent, by the way, for the 2024 election. Right. This becomes a battleground state now that Georgia is starting to see a little bit more Democratic influence.
Yeah, I was going to ask you. I mean, it's really interesting to see actually the differences and how the maps get redrawn for 2024. Yeah. In other news, Kriti, so 2 of Donald Trump's companies have been found guilty of engaging in tax fraud. What do we know? Yeah, so this is going to be the very first criminal charge for any Trump organization kind of lawsuit associated with. Of course, it comes at some pretty precarious timing as the former president runs again for 2024. This is crucial because, this is the first time it's a criminal charge. You've had civil suits in the past, but this is on top of him already dealing with the January 6th Capitol probe. He's dealing with lawsuits when it comes to how he handled classified documents as well in his Mar-a-Lago estate. And on top of that, just to make things worse, you're also dealing with civil suits from Letitia James, the DA from New York as well, talking about inflated asset values. Now, also note that for this particular case for the Trump organization, President Trump is not directly charged. It was just noted in the proceedings that he was aware of what was going on, tax evasion primarily, but simply not charged yet. So stay tuned for what the 17 counts actually look like. Thank you so much, our Kriti Gupta there with the very latest on Georgia. Now, coming up, I have actually Georgia on my mind, which nobody wants to hear me saying. The data shows a year of 2 halves for European tech, record-breaking investment in the first half, but a different story in the second. Europe's tech industry has lost more than $400 billion in value this year. That's according to a report by venture capital firm Atomico. So we discuss all of that with Tom Weimer. He's head of Insights. That's next. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open, everyone. We are 14 minutes into the European trading day. Quite a lot going on today, actually. Stocks broadly lower. Dollar gauge that we look at very, very closely. Headed for a third day of gains against the backdrop of uncertainty in China and also quite a lot of worries about what the economic outlook looks like in 2023. The bright spot, certainly if you're an investor in some of the drug companies, is GSK, one of the biggest gainers in today's trading session. That's on the back of a judge in the U.S. actually rejecting something to do with Zantac, saying it is not linked, according to the judge, and of course, according to this trial, to cancer. Sanofi also getting a boost out of that to gaining some 8%, Tom.
Yeah, a big day for the healthcare sector. Technology, by the way, is a sector down 0.8%. And I want to focus on that sector. We want to break down what's been happening this year because the data does show a year of two halves. For European tech, record-breaking investment in the first half, but a very different story in the second half. That is according to venture capital firm Atomico's annual State of the European Tech report. Join us now to break this down and get a look ahead to 2023 is Tom Weimeier, who is the partner and head of Insights at Atomico. Tom, good morning. Thanks for joining us on the studio. Let's talk about the investment flows then, because 2021 was such a big year for European tech in terms of those flows, a record-breaking year, about $100 billion, and you can correct me if I'm wrong. How does this year compare to 2021? Just how bad has it been?
Well, first of all, thanks for having me on. It's great to be here. There's no escaping it's been a tough year. So soaring inflation rates, interest rate hikes, of course, the war in Ukraine, makes for a very difficult backdrop. And unsurprisingly, you see that then reflected in the numbers. As you just said, it's been a tale of two halves. Really, really strong investment levels, continuing the highs from 2021. And then from Q3, 40% off. And where we think the year will settle is at around 85 billion of investment. That's down 18% year on year from 104 billion last year. Now, of course, you put that into perspective, that's still 2 times the level that we saw just 2 years ago in 2020. And we actually started doing this report 8 years ago. And back then it felt huge that we'd seen 10 billion of investment. So we're somewhere like 8.5 times up from that.
Okay, when's it more difficult to find funding? Is it late stage or early stage? And I guess what's the worst evil when it comes to growing some European tech talent?
Well, I think, we see it's a challenging environment to raise capital at every stage. There's no question that we saw the late stage environment become more challenging earlier in the year. So actually we started to see that really kick in from Q2. And then it's taken a little bit of time to trickle its way down into the earlier stages. And now, just in the last few months, starting to see there some signs of a more challenging environment. So valuations coming down, round sizes, declining, and overall investment levels also down there too.
And you talk about capital. Just how bad has the drought been when it comes to IPOs this year? And do you have any sense, when you look at your data, as to how things are shaping up for next year?
So we've become accustomed to seeing, good numbers of bumper billion-dollar flotations from European tech companies. Last year we had 25. This year, as the IPO window slammed shut, we've seen just 2, but really reflecting a trend that we've seen globally in the tech industry. So, a 30 times reduction year on year on a global basis in terms of billion-dollar tech IPOs this year.
Tom, it's a great piece of research, and also you look at the valuation or some of the, the market valuations, and basically $400 billion. I mean, look, think about the number; it's insane. Huge. In Europe, evaporated. I mean, does it actually mean that there's even going to be less funding in it next year? Is it just going to get worse before it gets better?
That's right. So we've seen 400 billion of value erased from the start of the year, so down from 3.1 trillion. To 2.7 trillion. I think what's, again, it's about perspective here. So when we started this report, we were measuring the total ecosystem value in the low hundreds of billions. We've seen that climb to 2.7 trillion, even with that correction. So we're still seeing, tremendous value being created around technology, though, of course, the numbers reflect a very different valuation environment.
And that, of course, has played into the way that these companies have looked to kind of cut some of the fat. And we've seen job losses, of course, notably high-profile Meta, Twitter, Stripe, but it's happening across the sector. How deep has that knife cut, and how much more bloodletting do you expect to see into next year? How much more work do they need to do in terms of shrinking headcounts?
Yeah, so I think the backdrop has been we had a growth at all costs environment. You're now seeing a lot of pressure to grow sustainably. That means how do you manage your burn? How do you make sure that you have the runway to make it through what might be challenging periods? And one effect of that has been global layoffs across the tech industry. We measured 200,000 on a global basis, and we have seen an acceleration of that in recent months. So November was a new peak. And I think, this is the right decision for companies to ensure they're on a sustainable path going forward. So, I think we can expect to see more of that coming into 2023.
Tom, a lot of the things actually, we covered. There's one thing that surprised me in your report, which is debt funding. How much of a concern is again, debt funding? And could we see a lack of liquidity? Like, is this, the one thing that could really kind of implode in coming years?
So, I think we've seen that companies are looking for all sources of capital. Debt has been, another means of accessing additional runway. And so we have seen increases in those volumes. I think the thing to keep in mind is the ecosystem benefits from a record level of available funds to be invested. So actually, one of the numbers we have in our report is $84 billion of dry powder. That's capital waiting to be waited to be invested. That's up 3.5 times. So, the ecosystem for sure is being tested, but the resilience that's been built as the ecosystem has evolved over the last few years, and the pillars that have been put in place around capital, yes, but also around innovation and talent, means that it's in a very strong position to be able to weather what is likely to be a challenging year ahead.
Another challenging year. Tom, before we let you go, which parts of the ecosystem, which companies are holding up better than others?
So one of the really interesting themes that we saw is a very strong level of investment into what we call purpose-driven companies. So companies really with a sustainability focus, and in particular in climate. Yes, it was a down year overall in terms of investment, 18% down. Climate investment has seen strong increased growth. So climate, I would say, is one of the sectors to watch out for where we're seeing a lot of activity.
Tom, thank you so much. Tom Weimeyer there, partner and head of Insights. That's a title to aspire to at Atomico. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. China has eased more COVID restrictions today, including allowing some people to quarantine at home rather than in centralized camps. The 10 new measures include accelerating vaccination among the elderly and forbidding local officials from designated entire housing compounds at high-risk areas. Test requirements to enter most public venues will also be scrapped. The European Union is to proceed with 2 cases against China at the World Trade Organization after talks failed to resolve the issues. EU Commissioner Valdis Dombrovskis says one dispute relates to restrictions on Lithuanian exports. A second is over what he calls coercive practices to limit patent holders from exercising their rights to protect innovations in court. The UK has agreed to end an effective ban on new onshore wind farms, a second major climb down for the government in 2 days. In the face of a rebellion among Conservative members of Parliament, the government has announced a consultation on letting local communities decide on new wind turbines. Russia is considering setting a price floor for its international oil sales in response to the G7 export cap. Two officials say Moscow is considering either imposing a fixed price or stipulating maximum discounts to benchmark global prices. There's no visibility yet on what the precise level might be. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Alice Atkins here in London. Thank you very much indeed. Coming up, more issues for Apple. One of their key iPhone suppliers warns production will drop on weak demand. We've got the details next. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 52 minutes into your European trading day. You're seeing losses across the benchmark of 0.4% as investors weigh up weak data out of China, overshadowing what is now a pivot on COVID-0 and the drumbeat of concerns around recession coming from the Wall Street titans overnight, the likes of the CEO of Goldman Sachs. So currently down 0.4%. One sector that is the standout now is healthcare, gaining a little over 1%, and that is tied into what is happening with the likes of GSK. I'm going to break down the details of that story, but get Francine to give you a little heads up as to what else we're watching today. Fran.
Yeah, so let's take a look at some of the things that we should be focused on. 10 a.m. UK time, we'll have some data from the Euro area, including third quarter GDP. 11 a.m., we have Chile's CPI reading, closely followed by the country's copper and export data. 12 p.m., we'll have the U.S. MBA mortgage applications. 3 p.m., there's a rate decision from the Bank of Canada, and of course later, 9:30 p.m., we're due to rate decision from Brazil's central bank, Tom.
Okay, before we get to the Apple story, I did promise you a little bit of detail on what's happening in healthcare then. GSK, Haleon, Sanofi all rallying on the back of a court win in the US. There had been claims, 5,000 lawsuits claiming that the heartburn drug Zantac, which they all produce, can cause cancer. That was thrown out. At the federal level, GSK has said it will continue to defend itself because at the state level, it could face further lawsuits. But you have analysts like Citi coming out saying the ruling represents the best case scenario for GSK and its co-defendants, and Barclays calling the GSK spin-off Haleon, they're saying that is now investable again on the back of that legal decision. Let's get to another big corporate that is in play today, and that is Apple. More issues for that company this morning. One of their key iPhone suppliers is warning production will drop on weak demand. It comes as the tech giant looks to reduce its dependency on Asia and make chips in the US for the first time in nearly a decade. Joining us now is our tech reporter, Aggie Cantrell, in Berlin. Aggie, let's start then with the concerns around production and demand for Apple devices. Where is this being hit in terms of their portfolio of products?
Yes, so it is actually not just Apple, but more broadly in across the headsets that we're seeing a drop in demand. But for Apple, this is a real concern also because they are still so heavily dependent on China and production in China for the creation of their iPhones. And while Apple doesn't report its own iPhone sales anymore, there is still this expected drop due to the issues around the lockdowns in China and also the demand drop, especially as consumers are squeezed.
So, Aggie, what does that mean going forward? Do we see like a change in how Apple will operate in some of the countries?
Well, I think something that's really interesting is also going on to what we're seeing from Apple's efforts to pivot towards having more of their production, as Tom says, less dependent on Asia. And a key part of that is also what they're talking about when it comes to making chips in the United States in this plant in Arizona. And that would be crucial for Apple going forward, especially as we're seeing a lot of other companies see that their dependency on Asia for high-tech parts of their production is becoming a concern, a geostrategic concern as well when it comes to China. And we're also seeing that as well when it comes to the United States' own efforts as a government to boost the chip industry within the US, something that is also being looked at in Europe as well, where we've seen the EU Chips Act that's been pushing for European homegrown chip makers to essentially effort towards deglobalization when it comes to the chip industry and become less dependent on TSMC, which is Taiwan-based, and obviously with everything going on between Taiwan and China, there is a fear within the chip industry that they could be undercut if there is any growing tensions between China and Taiwan.
Yeah, a really, really interesting and important dynamic. And Aggie, just briefly before we let you go, because this has been a subject of so much speculation and rumor, the Apple car, they're pushing back the deadline for this.
Yes, this is quite a strange move on the part of Apple, but essentially they're pushing back the deadline for this self-driving car as part of a broader issue that the company is seeing when they're being squeezed, essentially, when it comes to their core sales, such as the iPhone. So it seems like the company is refocusing their efforts on their current products and pushing back the deadline for these bigger ideas, such as the self-driving car.
Thank you so much. Our tech reporter in Berlin, Aggie Cantrell. Now that's it for the European Market Open. Surveillance Early Edition is up next. Of course, we'll have a full roundup of some of the markets, some of the movements and questions over China, and then we'll look at the dollar gauge, Tom.
Yeah, and you've got some great guests coming up on the 9 hour as well. Currently, the markets here in Europe down 0.2%. Futures in the US, S&P's just up 0.1%. Stay with us. This is Bloomberg.
they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Mixed signals. The yuan fluctuates as China accelerates the easing of COVID restrictions, returning the focus to growth. Trade data, though, slumps. Sounding the alarm, U.S. stocks slide as banks warn about the gloomy outlook. Goldman Sachs Chief Executive David Solomon says job cuts and smaller bonuses may be on the table. Plus, big pharma surges after a big win as a U.S. court dismisses cases against heartburn drug Zantac, while GSK jumps the most in 25 years. Now, first thing is first, so let's check in on the market. And here, actually, we have a much more subdued picture. European stocks falling, bonds extending some of the rally that we've seen over the last couple of weeks. A couple of question marks over China. Chinese trade data compounded fears about the health of the global economy. At the same time, China is saying they will reopen. So investors don't really quite know how to interpret that. Is that a positive? Will we really get the reopening? And what does the trade data mean going forward for big trading partners such as Europe? For the moment, European stocks down 0.2%. The only, the stocks actually that I see in terms of industry groups losing the most is still basic resources and energy technology, down some 0.6%. And then you can see the U.S. dollar index. We're looking at the Bloomberg U.S. dollar gauge, 1,270. Again, recession fear is really palpable in a lot of pockets of the markets, certainly in the bond market, where we're also seeing a yield inversion hitting a 4-decade extreme, sending the 10-year rate in the U.S. This is probably my chart of the day, below those 2-year notes by the most since the 1980s. So watch out for any stress, watch out for that yield curve inversion. The picture overall, when you look at Europe, for example, the DAX is unchanged, the CAC is unchanged. Again, we're going into December 2023. We're getting a lot of economists coming out with what they're expecting in 2023. I'm seeing a lot of titles saying, look, if you thought 22 was bad, 2022 was bad, wait for next year. The FTSE actually gaining some 0.2%. Now, some positive news, probably not if you're one of the 5,000 that could have litigated big pharma, but certainly if you're an investor in, for example, Sanofi, GlaxoSmithKline gaining some 11% and 7.5%. This is after a judge in the U.S. rejected a case that actually linked Zantac, the acid reflux drug, to cancer. The other big story is Apple. So this is what it's doing pre-market. We did see, I think, already a move on Apple. We had our Aggie Cantrell looking at, okay, pre-market, it's not doing that much. So keep an eye on it, $100 141.83. Now, coming up, we really have a fantastic lineup of guests. This is who we're focusing on. We have the NASPER's chief executive. We have Nouriel Roubini. I don't know if Mr. Doom and Gloom can be even gloomier than some of the inversion talk that we're seeing in the market, so that will be a good conversation on 2023. And then we look at possible M&A deals, the pipeline, banker bonuses as well, with Stéphane Boujna, the Euronext chief executive officer. This is a pretty stellar lineup, so stay tuned for that. Now, China set to announce further easing of COVID measures as soon as today. It comes as the country's exports and imports both contracted in November as external demand continued to weaken and a worsened COVID outbreak disrupted production and cut demand at home. Now, for more, we're joined by Bloomberg's chief Asia economics correspondent. He is Enda Curran. Enda, what are the details, first of all, good morning, on these China COVID measures? How much will they ease?
So it's another 10-point plan from the central government. It includes measures such as allowing people who get sick to quarantine at home instead of a government facility. There are changes to underground testing rules. They're easing up on testing to get into public spaces, for example. So it's a whole series of micro measures that are being interpreted as another step away from COVID zero by the authorities. Now, this is moving pretty fast. A lot of people say are now changing their projections on when China will eventually exit COVID zero. It should be said, though, there's still a long way to go on this. China has several layers of restrictions, unlike any other country in the world. But there's a view that given where the economy is at, the pressure on the economy, and given, of course, the protests recently, that the government is now pivoting and that it's happening faster than was anticipated even a few weeks ago.
So, and you know, when you look at the top lines for the November trade data, they didn't look good. Like, what are you expecting in 2023?
The trade numbers were definitely bad, and this again goes to the whole COVID story. Exports were slumping. That partly reflects weakening global demand. Imports were down. That reflects, of course, domestic weakness due to the ongoing COVID restrictions. And when you consider that exports, they're not a huge driver of China's growth anymore, but it was an important pillar in terms of China's economic recovery. That's now fading, and it's all feeding into this picture as to why China is pivoting on COVID. A lot of China watchers are saying with the economy in the space that it is, they have to pivot. They need to support the economy. The central bank came out this morning as well, by the way, with some commentary via the government that they will offer targeted and powerful support to the economy. So there's a change happening in terms of support for the economy, and there's a change happening on how they're approaching and handling COVID also.
Enda, thank you so much, as always, for your brilliant insight. Enda Curran there with the very latest on China. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
The Democrats have narrowly retained Georgia's Senate seat, giving them an outright majority of the U.S. upper house. Senator Raphael Warnock defeated Republican challenger Herschel Walker in the state's hotly contested ballot election, with nearly all ballots counted.
Yeah, I think, Leanne, I think actually I need to pick up. I think there was a sound issue. I wasn't quite sure if I was the only one not hearing you, but we will get more. Leanne was talking about Georgia, so we'll get onto that in just a second. Here are the rest of the top stories that we need to look at. So apart from Georgia, let's look at what else is going on. So we will see whether Georgia is definite of course, a Democrat state. Now, the European Union set to proceed with 2 cases against China, the World Trade Organization, after talks failed to resolve the issues. EU Commissioner Valdis Dombrovskis says one dispute relates to restrictions on the Lithuanian exports, a second over what he calls coercive practices to limit patent holders from exercising their rights to protect innovation in court. Now, the UK has agreed to end an effective ban on new onshore wind farms, a second major climb down from the government in 2 days. Now, in the face of a rebellion amongst Conservative members of Parliament, the government has announced a consultation on letting local communities decide on new wind turbines. So we'll have plenty more on our top stories. Coming up, a tough year for tech. Prosus has valued its global portfolio of internet assets well below last year's $50 billion valuation. We'll talk to the chief executive of tech investor Prosus next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now we're now joined by Bob van Dijk. He is the Chief Executive Officer of Prosus and Naspers. Bob, great to have you on the program today. We know that it's a big day, of course, with some of the choices ahead, what it means for Prosus and Naspers. First of all, Prosus has a very large cash balance sheet, which is, frankly, any chief executive's dream. I know there's questions about when you'll be profitable and things like that, but what are you expecting to do with that balance sheet going into 2023?
You know, when times are a little bit uncertain or a lot uncertain, which I probably would be the way I characterize where we are now, I think it is actually a huge differentiator to have a significant cash on hand, because you never know how the recession that we are likely to face will develop. It's also an opportunity when you see asset prices are depressed. We have a fairly high bar for further investment, but it could provide us with opportunity. It's typically when there is significant change and uncertainty that opportunity shows itself.
Yeah, so where would you see opportunity, Bob? And I know we need to talk about Tencent and, of course, when you're expecting the group to be profitable, excluding your stake in Tencent.
Yeah, no, so we have a few real focus areas for the group. So we've been investing quite a bit in food delivery across the world, and we're by customers probably one of the biggest players in the world. And food delivery is an area where we actually recently done a significant further investment when we bought the remainder of iFood in Brazil. And I think that is a good example of the type of investments that we want to pursue, because it's what we think a huge return opportunity. It's also a business we know really well, and it's one where we're comfortable that the risks are limited. So the bar is high, and core areas like food delivery are important for us, as well as EdTech, where we have a significant portfolio. So probably more investments in the things we know well, where we see things that we believe have limited risk and are potentially well priced.
But how do you see, I mean, where do you see the potential, for example, for food delivery? I mean, we're looking at 2023, forecasts for the economy, they're ugly. Inflation could get worse, and, people will have less money to spend. Like, what do you see as the biggest risk to 2023?
Yeah, look, you are absolutely right. There is definitely significant inflation. There is recession risk. We found that if you look at our businesses, we just announced results 2 weeks ago, and our e-commerce business is growing at 40%. That is such a level of growth, and that's so far in excess of, say, the growth of the economy, that typically whether the economy grows plus 2% or minus 2%, doesn't really matter that much, because the online products that we focus on actually grow much faster than the economy itself. So Typically, we might see some effects, but we expect strong growth ahead in spite of a tough economic environment. And we're very used to dealing with inflation, right? We've been operating in markets like Argentina and Turkey for many decades. So an inflationary environment is not a new thing for us to manage through.
No. But, Bob, are you expecting 2023 to be worse than 2022 in terms of economic outlook and therefore consumer spending?
No, I do think 2023 will be a tough year in terms of overall economic growth. I do also think that sort of the secular trends we've seen around people doing more of their activities online are ones that will continue in spite of times being relatively bad. And we also invest in an area called classifieds, which is typically around having people buy goods that already have been used, and that is actually counter-cyclical. So some businesses, of course, will be somewhat impacted, but other businesses will actually thrive in an environment where people feel the pinch.
Talk to me a little bit about, how do you see the quantifiable benefit of actually selling down your stake in Tencent and buying back your own shares?
Yeah, so it's been, since we launched the program in June, we created about $15 billion in value for shareholders, which we're obviously really proud of. And the discount has come down from sort of the mid-50s to closer to mid-30s. So it's been very impactful. And I think one of the things that is really important to emphasize is that because of the way the share price has developed, actually by doing this buyback at a discounted level, our exposure to Tencent per share actually goes up. Strange mathematics, but that's the way it works. So per share, you'll actually get more of Tencent rather than less because of this. And we are huge believers in the future of Tencent, and actually very positive about China as well. And I think sort of the recent news that you covered today and that we've been expecting is actually putting that confidence even more forward for us.
Yeah, and I know, it's a little bit tricky to explain on live TV, but Bob, there's a discount, right? So there's been an effect on some of the processed businesses being valued at a discount to the stake that you own. I don't know if it makes sense to all of our viewers, but I hope it does. When do you expect that change or that gap, I guess, to close, that discount?
Yeah. Indeed, it's basically, if you look at the combined value of all the assets we own and you compare that with our share price, there's a certain discount there. So that's the way we define it. And that actually has come down very substantially in the last 6 months, as I mentioned. And look, it's something that many companies that are diversified holding companies have, but it's a good sign to see that it's significantly come back from where it was.
All right, Bob, thank you so much, as always, for taking the time to speak to Bloomberg. Bob van Dijk, they're the Chief Executive Officer of Prosus and Naspers, joining us for an exclusive conversation. Now, coming up, Roubini Macro Associates Chairman and Chief Executive. He is the one and only Nouriel Roubini on his new books. Well, Mega Threat, it's one book, but I think he makes 10 points of what he's worried about, the 10 trends that imperil our future and how to survive them. That interview is up next, and this is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Well, we will get in a second to the Bank of America Chief Executive. I think we spoke to Brian Moynihan. We had a great interview at the Goldman Sachs Financial Services Conference in New York. The main focus, of course, was at 2023. How ugly is it? And what does that mean for bonuses and also bankers' jobs? Now, in recent years, the world is facing, I know you know, facing growing risks not witnessed for decades, from wars to debt crises, pandemics to climate change, overpopulation to superpower rivalry. The list of challenges facing policymakers and leaders is daunting. A new book, Mega Threats, the 10 Trends That Imperil Our Future and How to Survive Them, seeks to summarize and find solutions to these risks. Well, the author of the book, Nouriel Roubini, Mr. Doom, I don't know whether we should call him Mr. Doom anymore, Chairman and Chief Executive Roubini Macro Associates, joins us now. Nouriel, great pleasure. Finally, we got you to the London studio. It's a great book. It's a bit of a depressing read, but at least you give also solutions on how to deal with it. Let's forget the doom and gloom for 1 second. Is there anything where December 7th, 2022, that you point to and saying, actually, it's a little bit better than expected, or it could be in 2023?
No, I feel that right now things are going in the wrong direction.
Yeah.
We're entering a recession in most advanced economies, starting with the United Kingdom and the Eurozone, also in the United States soon enough. And inflation is still too high. So we're entering a stagflation like we're not since the 1970s. But in the 1970s, we had negative supply shocks, but debt ratio, private and public, as a share of GDP, were low, 100%. Today, they're about 400% of GDP and rising. No. So not only there's a risk of inflation and stagflation, also the risk of a debt crisis, because now central banks have to increase interest rates to fight inflation. So institutions, private and public, that are insolvent, they're going to go into bankruptcy.
But we know this, right? Yep. We've known this for quite some time. So I would imagine that the greater good, or at least leaders, are taking action to soften the blow.
Unfortunately, central banks are facing a dilemma, because whenever you have a negative aggregate supply shocks, either you raise interest rates to fight inflation and you cause a hard landing, and we're headed towards a hard landing, or if you do the reverse and you care about growth and jobs, you don't increase interest rates enough, then you end up with a price-wage spiral and a de-anchoring of inflation expectation. But on top of this trade-off, there is a new one, because today there are also issues of financial stability. There is so much private and public debt that the risk is not just of a hard landing as central banks are going to increase interest rates, but also risk of a crash in bond markets and credit markets and creating tighter financial conditions that make the recession worse.
But this is what, Nouriel, so you're not talking, and really congratulations on the book. It was a great read, and I thoroughly enjoyed it. But you're not, are you talking about treasury, liquidity, or is it shadow banking? Because when you look at financial stability, it's not that banks will go under like 2008. It's other parts of the markets that are, away from, I guess, the more established financial base.
You're right. During the global financial crisis, it was mostly household debt and the debt of the banking system. Today is more corporate debt, the shadow banks that finance that corporate debt. leverage loans, CLOs, private debt, high yield, high grade, fallen angels. And now we have also the problems in many parts of the world. Sovereigns are so indebted that you can have a debt crisis. And we saw some of those signals, what happened the last couple of months in the United Kingdom, where reckless fiscal policy led to a sharp rise in interest rates and a fall of the currency.
Nouriel, when you look at some of the data out of the US and elsewhere, they're not as bad as expected. So is this a blip and you expect it to turn out really bad in 2023, or because of innovation, because of resilience, frankly also because of the pandemic means that people have adjusted, even supply chains, we could have, you know, a hard landing maybe on the softer side?
Well, now, until this year, people were saying there'll be a soft landing. Now the consensus is that it's going to be a hard landing, but it's going to be a short and shallow recession, maybe only a couple of quarters, plain vanilla, garden variety. I beg to differ. First of all, we're having a situation which, unlike the GFC and unlike the beginning of the COVID crisis, you are having to increase interest rates and have a tighter credit in a situation in which the economy is slowing down, going into a recession. Two, everybody's doing around the world. Three, the debt levels are much higher than they were 10, 20, or 30 years ago. And we don't even have room for massive fiscal stimulus. So I think that the conventional wisdom was wrong on believing that inflation was temporary, was wrong in believing it was just a bad policy. There were also negative supply shocks. And now they're saying there's going to be a short and shallow recession. I think it's going to be a severe recession. The other way I think that the conventional wisdom is wrong is they say central banks are committed to fight inflation at any cost. I think that we're not only in a situation of fiscal dominance, in a game of chicken between fiscal and monetary authority, the monetary ability to blame, but there is a debt trap. There is so much debt that you have to let essentially inflation go higher to wipe out some of the real value of that nominal long-duration debt.
Nouriel, is it even deeper that actually central banks really thought they could fix anything? And so is there like an illusion of grandeur that is now biting us?
Yes, I think that a lot of the buildup of the debt that occurred in the last few decades is because central banks had too loose monetary and credit policies. Every time there was a bubble, they weren't fighting it and then picking up the mess afterwards. That led to a bias for excessive leverage. And right now we have so much debt, private and public, that the idea central banks can fight inflation is not credible. I think they'll have to blink, they'll have to wimp out, and we're going to have higher inflation expectations down the line.
We're just getting started with Nouriel Roubini. I mean, there's one, but I don't think we have to pay for the bill, so we have to go to break. Globalization, page 153. Globalization as a concept stretches back to the earliest exchanges of goods between consumers at a village. We'll talk, of course, about globalization, the debt crisis, the bailout map. We'll talk about stagflation, which we mentioned, and the new Cold War. Nouriel Roubini, Chairman and Chief Executive of Roubini Macro Associates, stays with us. We'll also talk, of course, about market valuation. In one word, are you happy you're in London?
I love London.
Is London better than New York?
It is. It is a nice place. I love Europe, and I grew up in Europe. So
there you go. Roubini, long on the city of London. We'll discuss that next. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Good morning, everyone. Here are your top stories. Mixed signals. The yuan fluctuates. China accelerates the easing of COVID restrictions, returning the focus to growth. Trade data slumps. Sound the alarm. U.S. stocks slide as banks warn about the gloomy outlook. The Goldman Sachs chief executive says job cuts and smaller bonuses may be on the table. Plus, Big Pharma surges after a big win as a U.S. court dismisses cases against heartburn drug Zantac. GSK jumps the most in 25 years. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, still with us, Nouriel Roubini, Chairman and Chief Executive of Roubini Macro Associates, with a great new book out, Mega Threats. Nouriel, amongst those mega threats, and again, it's beautifully laid out. It's 10 mega threats, and what are the things that we can do and leaders can do to try and mitigate them. You have AI job destruction, you have the new Cold War, you have also the climate catastrophe. When you look at AI innovation and technology, can we harness it in a different way to actually help us with our goals?
Well, certainly AI, machine learning, robotic automation is going to increase the economic pie, even if the macro data do not show yet the increase in productivity. There's a bit of a paradox. The only trouble are two. One is that AI and machine learning is capital intensive, skill buys and labor saving. So if you own the machines, the robots, or the capital owns those machines, you do well. If you're in the top 10% of distribution of skills, education, human capital, probably the AI makes you productive, more productive. But if you are a low value added, blue collar, but increasingly also white collar worker, or even middle value added, your jobs and your income is going to be gradually displaced by technology. Initially routine jobs, then cognitive jobs. Now with this chat GPT, even creative jobs.
But we've been talking about this for 10 years. So why did we not fix it earlier? This is, again, it's a jobs mismatch, it's a skills mismatch that could have been fixed with the right training, but also over timeline that is longer than we have now.
Well, in many parts of the world, starting with the US, we have not really invested into skills very much. The level of education is mediocre, especially in STEM compared to other parts of the world. But in the past, there was a skill premium that comes from education. The trouble with AI is that even that education skill premium may disappear because even jobs that are not just mechanic routine, but also cognitive or creative may be eventually displaced by technology. So education used to be the solution. It might not be as much in the future.
Nouriel, who's getting it right? So we also have, big stories today on China, easing some of the curbs on, on restrictions so that they can travel more freely. So it feels like they're abandoning COVID zero policy. Does China actually really benefit from some of, if not the innovation, some of, the focus on AI? I mean, because of the large number of people, they just have better AI than us.
Well, they have no privacy, they have more data and so on. The trouble with China is that there are aging of population is becoming more and more state capitalism rather than private sector driven. And the technology of the future require knowledge, innovation that require freedoms they don't have. And it's also politically becoming much more authoritarian, on foreign policy becoming more aggressive. And you have a huge amount of debt, private and public. You have a real estate sector is going to crash and so on. So China is going to be at best 2-3% growth in the next few years, I would say.
So it doesn't really help the world economy like we thought it could 2-3 years ago?
No, certainly in the past when China was growing 10% was a major driver of rise in growth in emerging markets, even export by Europe to China. Today I would say China is going to be stuck into a middle income trap. And it's going to probably avoid a hard landing, but it's going to be very mediocre economic growth going ahead.
Okay, if you look at recession fears in the U.S., and I think you absolutely don't think we could avoid a hard landing. I mean, one of the indicators that we watch is, of course, the inversion of the yield curve between the 10 and 2 year. Is this a good indicator? I mean, we haven't seen it so inverted since the 1980s.
Usually it's a good indicator, but sometimes, of course, there are false alarms. It's not always the case that when it's inverted, you're going to get a recession. But I think that the most important thing is that in the last 60 years, there's never been a case in U.S. history that you have inflation above 5%, right now 7.7, unemployment below 5%, now 3.7, that when the Fed starts to raise interest rates, you get a soft landing. You get, in every case, a hard landing. Even when you have cases of overheating from aggregate demand, let alone when you have like the 70s situation with negative supply shocks that reduce growth, increasing inflation, and when you raise interest rates, then you end up into a hard landing.
I mean, what would need to happen for us to see a kind of freeze of capital markets? You know, like 08?
Well, we're already seeing a significant rise in long bond yields. Credit spreads, high yield and grade are much higher. In the leveraged loan market and CLO markets, things are almost shutting down, not yet, but the spread have widened so much that the issuance has become much lower. So all the kind of excesses that occurred not in the banking system, but in the shadow banking system, that was private debt, CLOs, leveraged loans, fallen angels, high yield, those things are markets that slowly are becoming more distressed over time. And as we enter in a recession, the spread widening is going to be much more significant.
And we're seeing stress points, right? We saw something yesterday in currency derivatives. We're seeing, you know, places in bonds. Where do you see it first? Is there something that you think could blow up before the end of the year?
I think that the stresses are going to come in the credit markets. If we're going to enter a recession, lots of institutions like corporates, households, businesses that are highly leveraged, I call them zombies, that are effectively insolvent, that were bailed out during the GFC, during the COVID crisis with zero rates, negative rates, CE, and quantitative easing, that will have significant increases in debt servicing ratio. So you're going to see distress in credit markets.
But no, these are probably not companies. I mean, is it companies that I mean, without taking a judgment, that actually, you know, shouldn't have stayed alive so long in the first place?
I mean, the Fed...
Or is it healthy companies?
No, they were not. I mean, before the COVID crisis, the Fed was writing financial stability reports saying that their worry was about the corporate sector. High debt, trillions of dollars, leveraged loans, CLOs, high yield, fallen angels. And what happened during the COVID crisis, that those institutions, those corporations, not only didn't go bust, but they were bailed out. Went to zero rates. We even bought high yield bonds. And therefore, everything was bailed out, and they borrowed even more. Today, unfortunately, with the rise in inflation, the Fed is rising rates from 0 to 4. They're going to go at least until 5.25, possibly, in my view, closer to 6%. Then the institutions that are insolvent are going to have to go into distress. And that's the credit stress.
And so that credit stress, what does that mean in terms of correction for the markets, for example, for equity markets? How much lower should we be?
Well, you know, even if you had a short and shallow recession, typically from peak to trough, the S&P 500 falls by 30%. During the GFC, it fell by 50%. So even if we had a mild recession, right now the market is down, depending on the day, 15% from the peak, you'll have another 15% leg down. If we have something more severe than a short and shallow recession, but not as severe as GFC, you have to go to minus 40 from minus 15. So you have another 25% downside potentially in the markets.
What are you seeing in London? Is it, or do you really think, I mean, you just said before the break that you love London because it's a beautiful city.
No, I love London, but...
Financially, what will it become?
Well, let's put it this way. First of all, the UK is already in a severe stagflation, a double-digit inflation, and even the Bank of England is expecting at least 5 consecutive quarters of negative economic growth. Secondly, it's worse than the Eurozone because there was a self-inflicted wound, and there was Brexit that reduced the supply of labor, restricted trade in a number of ways, weakens the role of city as a major global financial center, reduces potential growth, and increases cost of production. So the fact that the UK, relatively speaking, is doing even worse than the Eurozone or Europe or the United States is definitely a Brexit phenomenon.
Can they put regulation in place or incentives in place without spending too much like we saw in the last couple of months to reverse some of the negative effects that it's had on the economy?
Well, there is this talk about becoming like Singapore, reducing regulation, reducing taxes, reducing government spending. First, the comparison is wrong because Singapore is a high tax, high spending, high regulation country. The comparison should be with not Singapore, but with Hong Kong. But you don't want to compare it with the Hong Kong of today. Secondly, I think the idea that you're going to cut regulations is totally far-fetched. If you want to have access, even with a free trade area, let alone a customs union to the European market, you need to maintain the same regulation. And the idea that you're going to cut massively government spending to reduce taxes is also far-fetched. It's not going to happen. If anything, they have to raise taxes right now, given the amount of government spending.
So what would you do?
I would say that right now, unfortunately, the United Kingdom is stuck in a low-growth situation. What you want to avoid is a loose fiscal policy going to lead to the type of stresses that occurred with the pension funds, and that's a risk. Literally, for a month or so, the UK was being priced like in emerging markets, with fiscal stimulus leading to a weaker currency and much higher interest rates. It's a severe risk that actually you have financial instability and distress in the case of the United Kingdom.
Nouriel, you also in the book talk about this new Cold War. I mean, it's incredible to think what we've lived to, frankly, in 2022. It's like a whole decade, and some of the concerns was distilled in the last 12 months, including the war in Ukraine. Will Europe stand together as the winter gets colder?
Europe will stand together, and NATO is now becoming stronger with the Swedish and the Finland joining in. But we live in this geopolitical depression. There are four powers, China, Russia, Iran, North Korea, possibly also Pakistan, that don't accept the economic, financial, political, and geopolitical order that the US, the West, and Europe created after World War II. And this geopolitical depression is going to lead to decoupling, to fragmentation of the global economy, balkanization of global supply chains, secure trade rather than free trade, feng shoring rather than offshoring, and all those things are going to reduce potential growth and increase cost of production. They're also stagflationary. This process of deglobalization, of protectionism, and of decoupling.
This is my favorite party trick, trying to get to find some glimmer of hope in all of your predictions. Nouriel, I mean, could you see a situation where actually things, so Europe holds together, but also it kind of brings more innovation to Europe? Is there anything that you've been surprised on the upside?
Well, you know, in the race about the industries of the future that are based on AI, machine learning, IoT, big data, 5G, 6G, there's a lot of good, maybe academic or theoretical work done by Europe. But if you're looking at the application, it's mostly the United States and China. Now, there are lots of European plans about building AI and you name it, but I think that realistically, Europe is falling behind, and that's a certainly risk to the potential growth of the Eurozone. These days, a game between US and China, I would say, on the industries of the future.
Nouriel, thank you so much. It's a real pleasure. I'm glad we finally made it happen in London, so you have to come back soon. It's a fantastic book. Look at this, a little bit of QVC action for me, Mega Threats by Nouriel Roubini.
Thanks for having me.
Of course, the chairman and chief executive of Roubini Macro Associates. Now, coming up a little bit later in the program, London no longer home to Europe's biggest stock market, with Paris now taking the crown. We speak to the Euronext chief executive, Stepan Bujna. That's coming up later, and this is Bloomberg.
Now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a few weeks ago, London was overtaken as Europe's biggest stock market. The crisis and confidence in the UK assets ran so deep that the country narrowly lost the crown to its nearest challenger, Paris. Brexit, a weak pound, and political upheaval have all been blamed for London's decline in this corner of the financial services sector. Now, we're now joined by Euronext Chief Executive. He is Stéphane Boujnah. Thank you so much for joining us, Mr. Boujnah, from our Paris office. Now, first of all, when you look at the potential for Euronext and, frankly, all of the industry in 2023, are you worried about what's coming, or how many opportunities do you see laying ahead?
No, we are extremely positive about 2023. We are observing an increased appetite of corporates for considering going back to the IPO markets. Clearly, the changes in the environment in the debt markets are re-rating the importance of equity markets. Clearly, more and more companies are rebuilding their balance sheet strength and reconsidering own funds and equity as a fundamental part of the financing of their growth. And 2022 was good in terms of IPOs. That was less good than 21, which was a record year. But 22 was a year which was consistent with the level of 19 and 20.
Do you think Paris is now a more attractive place to have an IPO after Brexit?
Well, Paris is a city where many companies are listed, but Paris is relevant only to the extent that it is one of the 7 gateways to the Euronext single market. There have been a lot of buzz and interesting comments about Paris aggregate market capitalizations being bigger than the London aggregate market capitalizations. But to a certain extent, it is irrelevant, because what really matters is not where companies are listed, but where companies are traded, in which market. And in this respect, the relevant metric is the fact that Euronext has built a single liquidity pool, a single order book, a single technology platform with an aggregate market capitalization of approximately 6 trillion euro, which is twice the size of the London market, and with about 12 to 13 billion euro of average daily volumes, which is twice the size of London. So what I want to highlight is that what is really impressive and really important is the integrated, consolidated market that exists across Europe and that we have built over the past 6 years.
I love that. That was like a lesson in diplomacy, Stéphane. You basically says, yes, you say France is a better place, but you didn't say it in as many words. London, as you say, is where a lot of, or most money changes hand each day. Do you think this could actually change?
Brexit was a big decision, and big decision entails big consequences. London used to be the largest financial center of the European Union, and everybody liked it. Today, London is the largest financial center of the United Kingdom, with global ambitions that are in the making and to deliver to a certain extent. So we are in an evolving situation, but clearly what is happening is that companies that under other circumstances would have considered being listed in London are listed outside of London. Ryanair left London to be listed at Euronext Dublin. Universal Music Group, a US company, decided to list at Euronext Amsterdam, and they could have been listed in London under previous circumstances. Allfunds, which is a Spanish company with significant operations in London, decided to list at Euronext Amsterdam, etc. This is the new normal. So I'm absolutely sure that the UK will continue to have an history consistent with its geography, and the geography of the UK is Europe, and the history of the UK is Europe. But as far as financial markets are concerned, clearly something fundamental has happened and is creating the consequences we are seeing today.
I mean, has your next business also benefited from the equity market volatility this year?
Yeah, clearly, because we have built in parallel to Brexit, which started in 16, sorry, because we have seen in parallel to that the building of a very large integrated market, when 25% of the shares traded in Europe are not traded in Euronext markets. We are internalizing more and more of the flows, and clearly the volatility is creating an opportunity for all markets because they are integrated in something which is now very large and very relevant for listing, for trading, and for post-trade.
When you look at M&A, where do you see opportunities to build up businesses? Is there something that you think Euronext could be much better at by acquiring something?
Yes, external growth is a fundamental part of our strategy. I mean, clearly the growth of Euronext over the past 6 years has been the consolidation of European markets with the acquisition of the Irish Stock Exchange in 2018, the acquisition of Oslo Børs in 19, Borsa Italiana in 21. So if and when opportunities arise, we will continue to look at opportunities to expand our footprint and to connect better European local economies with global markets. That is our purpose, and that is what we have tried to do over the past 6 years, and that we are going to continue delivering.
Okay, Stefan, thank you so much. Stefan Boujnader, the Chief Executive Officer of Euronext. And of course, the conversation with Stefan also continues on the podcast. That's out tomorrow. We'll talk about clearing houses and, of course, other things that we'll expand on, including some of deregulation, Big Bang 2.0 here in London. Now, coming up, we'll get a roundup of your top stories, including Big Pharma, GSK and Sanofi surging after U.S. courts win around a heartburn drug. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Morgan Stanley is to reduce its workforce by about 1,600, some 2% of total staff, as Wall Street prepares for a potential U.S. recession. Meanwhile, speaking to Bloomberg, the Goldman Sachs CEO David Solomon struck a downbeat note about the economic outlook and said potential job cuts should come as no surprise.
We're at a very uncertain time, given we're changing monetary and economic conditions very, very quickly. And that's certainly having an impact of slowing down economic activity. And so if you're running a big financial services firm, I think you have to assume that we have some bumpy times ahead. We could see a recession in 2023 also. And so I think you've got to be cautious and prepare.
Now, it is reported that privacy regulators at the EU will rule that Facebook owner Meta shouldn't require users to agree to personalized ads based on their online activity. Such a ruling would limit the data the company can access to sell targeted adverts. Meta shares have fallen by about 2/3 this year. GSK and Sanofi shares have risen sharply after a U.S. federal judge rejected the scientific evidence behind more than 5,000 lawsuits claiming the heartburn drug Zantac can cause cancer. UK-based GSK welcomed the ruling and says it will continue to defend itself vigorously, including against all claims brought at the state level over in the US. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. This is a picture for some of the pharmaceutical companies out there. We're seeing a big boost for GSK, but also Sanofi. This is on the back of a judge in the U.S. actually saying that there's not linkage between cancer and one of the acid reflux drugs that they're producing. GlaxoSmithKline, you can see, gaining 8.6%, Sanofi gaining 5.7%. The picture also for some of the other things we're watching out for, including Brent and actually, in general, commodities. This is a picture, I think, if we have that, there you go, NYMEX 73.23. Now, stocks in general slipping. We did have some China data actually compounding some of the fears over a recession. Now, recession fears definitely palpable in the bond market, where a yield inversion were hit by a 4-decade extreme, sending a 10-year rate below those 2-year notes by the most since the 1980s. We'll have plenty more, of course, on that throughout the day. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kay Lines in New York. Anna Edwards is here in London, and this is Bloomberg.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. but to the extent the demand falls, then the price will go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
These CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg. Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
We're at a very uncertain time, an uncertain time given we're changing monetary and economic conditions very, very quickly. And that's certainly having an impact to slowing down economic activity.
The reality is that consumers are starting to run out of dough.
I actually don't think that it's a foregone conclusion that we'll see a recession in any segment of the labor market. I do think we'll see a transition.
The likelihood of a soft landing is quite low. Yes, it's possible. Yes, there's a hopeful scenario where you can get a soft landing, and everybody would like to see that. But we need to be realistic.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Democrats get a big win. Senator Raphael Warnock defeats Republican Herschel Walker in the Georgia runoff. China makes a major shift from COVID-0. Beijing eases restrictions in an attempt to boost the economy and quell public discontent. And job cuts on the way at Morgan Stanley. Bloomberg's learned the bank will eliminate 1,600 positions. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. And Kaylee, we got some seemingly big news out of China in terms of the scale and the scope and the speed of lifting of some of those COVID measures, but not enough to capture the market's attention, it seemed.
Yeah, there was good news and then there was bad news, arguably, out of China overnight. Obviously, as you say, Anna, on the good side of the equation is that rapid, more rapid than expected, perhaps, easing of COVID-0 related restrictions. But on the other hand, you also had weaker economic data, both exports and imports in the month of November contracting more than expected. So really speaks to the struggle remaining in the Chinese economy. So that, coupled with maybe some concern about a spike in infections if restrictions are eased, took risk appetite much lower in Asia overnight. The MSCI Asia Pacific Index overall down about 1.4%, and the Hang Seng China Enterprise Index underperforming, down about 3.3%. Interesting, though, while Chinese equities were under pressure, the Chinese yuan has held in there mostly against the U.S. dollar. It's essentially unchanged, the offshore yuan to the dollar right now, trading at 6.98. But the big underperformer in Asia is the Japanese yen, weaker against the dollar by about 0.5% after a BOJ board member pushed back downplayed concerns about higher wage growth, pushing back on the idea that monetary policy needs to be adjusted. And as a result, the dollar trading at 137.59 to the yen. Matt.
All right, interesting to see that dollar movement. Although on my board, I've got the Bloomberg Dollar Index here in the second row, but the bottom of the board I think is the most interesting. An incredible drop in crude prices And all the more interesting since we continue to talk about this kind of incremental reopening of China. We've been down to 72.75 on NYMEX crude today. That's the lowest level since 2021. So even as we talk about a reversal of the COVID zero policy, or at least a loosening of the COVID zero policy, we're still seeing a huge drop in crude. And I think that shows you how concerned this market is about a recession in 2023. We're going to talk about all the bank CEOs coming out with super negative, well, not super negative, but definitely bearish outlooks yesterday, and that's being reflected in the crude price right now, trading at $73 for NYMEX. Brent also down. S&P futures are off 0.2%, which doesn't seem all that bad until you look at the cash trade over the last couple of days. We've been down more than 1% over the past couple of days. So as we get positive economic data out of the U.S., like the jobs number on Friday, like the ISM services number on Monday, that just convinces the market that the Fed's going to have to raise rates more. That's going to hit the economy harder in 2023, and that's why they're selling off stocks. That's why they're selling off oil. We see the dollar index right now, very little change, but at 1271 from a high of 1350, and the 10-year yield at 352 from a high of 424, I think. So very interesting to watch this space, but really it's all about oil for me today, Anna.
Yeah, absolutely. All about oil. I've got Brent in my board as well. Let's start, though, with what's happening at the European stock market level. And to your point, Matt, it seems the narrative around weaker global growth, what the Fed does about that, that's all outweighing the potential upsides from China reopening in the market psyche this morning, because we see European equity markets moving weaker, down just 0.1% in London, but elsewhere down 0.4% on the DAX. And on the CAC 40, we just got a confirmation, the final reading of third quarter GDP for the euro area. It came in at 0.3%. The initial reading was 0.2%. So slightly better than anticipated, very much at the margin. But of course, all the focus is really on just how quickly we do go into a recession, how deep it will get for the Eurozone economy and for more broadly the European economy. We'll talk about that in a moment with one of our guests. Here's Brent crude then, as Matt was pointing out, real weakness coming through in WTI despite the reopening narrative in China. We had the ingredients, if the market had wanted to send oil higher on the back of that. But 78.20 is where we are, down 1.5%. So a handle now on Brent below $80 a barrel. Sticking with the commodities theme, this is the UK natural gas market, and I put this in here. This is up by just under 4% today because we are in for some cold weather over the next few days, and we're in for some cold weather and some snow apparently, and all of that at a time when wind turbines are not spilling all that effectively over the next few days, not expected to at least, and so that could push the price of gas up. We see a little bit of that today. GlaxoSmithKline and Sanofi, this is the same story. I could have put in Haleon as well. Haleon, which is the consumer unit that was spun out from GlaxoSmithKline just months ago. All of those stocks rallying really strongly. GSK was up around 14% earlier on today. This on the back of a ruling by a US court or a US judge deciding to throw out the scientific evidence that had been provided by plaintiffs in a case that was trying to prove a link between the heartburn medication Zantac and certain types of cancer. The judge has thrown out that scientific evidence, and so the manufacturers of that on-brand and also generic drug move higher today on the back of that news, Matt.
All right, very interesting stuff indeed. Let's get to the political angle this morning, because incumbent Democratic Senator Raphael Warnock has won a contentious re-election in Georgia. It was a runoff vote, of course. Warnock defeated Republican Herschel Walker with a little more than 51% of the vote. Joining us now from Washington is Zach Cohen, Bloomberg government Congress reporter. And Zach, we've been going over this over the past few days, but just to explain again why it's so important that the Democrats have 51-49 rather than a 50-50 split with the vice president helping them tip the balance.
Right. Over the last 2 years, Democrats have had a sort of nominal majority in the U.S. Senate, as you mentioned, because Vice President Kamala Harris is able to break ties on procedural questions or on final votes. That allows them to essentially overrule Republicans, even if technically it is split 50 Democrats, 50 Republicans. With Senator Warnock winning re-election over Republican Herschel Walker, that gives them an outright majority, not just on the floor, but in really key committees, and that should help them move along, nominees, bills, what have you, that typically only require a simple majority. Now, the filibuster is still a factor. Democrats still have to contend with a 60-vote threshold in order to advance most legislation. But certainly an outright majority, 51-49, is going to help Democrats accomplish their agenda much more easily than they were able to with a 50-50 split with the caveat that, of course, Republicans narrowly flipped the U.S. House, and so there will need to be some bipartisan negotiation in this new era of divided Congress.
Right. It's going to be a divided government for 2023 and 2024. But as we look ahead to 2024, what does the fact that Georgia elected Warnock for a 6-year term mean for the presidential race? This was a solidly red state in the past.
Yeah, Republicans used to be able to count Georgia in their column regardless of the race, whether it was for president, or Senate, governor, and the incumbent governor, Republican Brian Kemp, was able to easily win re-election, whereas Senator Raphael Warnock won re-election, and President Biden carried the state in 2020, albeit by a very narrow margin. And so 2024, it'll absolutely be another one of those really key competitive states that Biden or former President Donald Trump or whoever the nominees for the major parties will need to compete in. Warnock was able to win by carrying Atlanta and some of the suburbs, while the rest of the state really went for Walker. And so Atlanta really does seem to be a really key indicator here of where future races could go. But I can expect that, after millions of dollars spent just in the last 4 weeks on television advertising in the Georgia Senate race, that certainly voters there should expect to hear a lot more from both political parties in the lead up to 2024, when, again, it will be a key race for the presidency.
Zach, thanks very much for your time. Zach Cohen of Bloomberg Government joining us there from Washington with the latest on U.S. politics and that Georgia runoff. Now, China is moving away from its long-held COVID-0 approach, easing a range of restrictions, and some of these now national easing of rules. It comes as the country's exports and imports both contracted in November, external demand continued to weaken, and a COVID outbreak disrupted production and cut demand at home. For more, we're joined by Bloomberg TV's Tom McKenzie, who has a rundown of everything we need to know connected with the China story. Tom, what is the detail of these China COVID measures then easing? Because for a time we were talking about maybe more piecemeal measures in certain geographies, but this seems to be more broad-based.
It is, and it's more significant. So you're right. We've had the rumors, we've had the speculation, we've had some easing and then U-turns on the easing. Now, though, you have the Communist Party's Politburo, the powerful Politburo, coming out and saying that the pivot is there, crystallizing, cementing that pivot away from COVID-0, saying that the time has now come, that China is able to move away from a policy they still claim as a success, particularly in terms of keeping the death rate lower and the infection rate lower. So we have measures including you no longer need to test to get into many public venues like shopping malls and restaurants. You don't necessarily have to go and have forced quarantine in a government quarantine center. You can now quarantine at home. And they've also eased some restrictions around travel as well. So this is consequential. This is today the moment when China has signaled it is pivoting away from this controversial COVID-0 strategy. The crack team, though, of analysts at Trivium, and I need to name check them because they're on the ground in China, they've said that walking out of exiting COVID-0 is going to be no cakewalk. It's going to be challenging, and maybe that's why investors are pausing for thought this morning.
And I could think of another potential reason why investors are pausing for thought, Tom, and that is that the data was relatively weak when it comes to November trade figures. Tell us more about that.
Yeah, so exports and imports both down between 9 and 10%, a drop of about 9% for exports for the month of November, imports down about 10%. And the context, Kaylee, is this, that exports have been powering ahead in the last 2 years, a key pillar of strength for China's embattled economy. That strength is now crumbling. These are the weakest numbers we've seen since about early 2020. Now, the government, policymakers have said, look, they're going to react forcefully in terms of targeted but forceful measures on the fiscal front, monetary policy as well. But you're absolutely right. This weak data underscores why they need to wrestle themselves away from COVID-0. There's the weak external demand picture, and that's despite the fact that we're heading to the holiday season, and the domestic demand as well as those production constraints. So all of those three things coming together, a kind of whirlwind of challenges for the trade sector out of China. And again, underscoring why they need to act. And again, that additional monetary and fiscal policy response that we should expect in the weeks, months ahead, particularly as we're looking to 2023.
Tom, thanks very much. Tom McKenzie joining us there with the latest on the China story. Now, US bank CEOs are striking a cautious tone, yes, have been striking a cautious tone, at the Goldman Sachs US Financial Services Conference. Goldman CEO David Solomon warned of bumpy times ahead for the global economy.
We're at a very uncertain time. An uncertain time given we're changing monetary and economic conditions very, very quickly.
The economy is being slowed by the higher interest rates, by the fact that the inflation has eaten up more of a person's savings.
I think you've got to be cautious and prepare.
If we head into a sustained recession, and I think we will go into a recession next year in the U.S.
We could see a recession in 2023 also.
If we have to make tough decisions, which I think we might, we will do that.
I just think it's going to be a rude awakening.
We have some bumpy times ahead.
Now, with Wall Street preparing for a potential U.S. recession, Morgan Stanley is planning to cut its global workforce by about 2%, amounting to roughly 1,600 employees. Bloomberg's Kriti Gupta joins us now with more detail. Kriti, take us through the sort of negativity we're hearing from Wall Street executives, how significant a move that is, and how that translates into job cuts.
Well, it's a real pivot, not to use a Fed term here, but it's a real pivot from what these Wall Street CEOs have been saying for a while. Think Jamie Dimon, think Brian Moynihan of JP Morgan and Bank of America, respectively. They've both been massive advocates, very vocal advocates for the American consumer. They're saying, look, the data is not that great, but the consumer is going to keep spending, and they have been right until now. The game changer here is what David Solomon said. Remember, he's been a skeptic on the U.S. economy for some time now. So to actually see him be out in front of this and start to say, okay, well, not only are we going to have a recession that's starting to seep into the base case, now we can actually zero in on timing and really say it's going to happen in 2023.
All right, so a lot of bad sentiment coming out of Wall Street CEOs yesterday. We also had news on Credit Suisse that it's trying to reel back in some of the $90 billion in outflows it lost from wealthy clients. They're offering as much as 7% in low-risk rates.
They are, and it's all at its core a liquidity story. Of course, there's those solvency rumors back in October. They've lost about 10% of their business. And the way to recoup some of those funds, well, they're doing it in pretty dramatic ways. Get this, some deposits of 5 to 6% return or interest rates, that's what they're offering here. Even some fixed rate notes of as much as 7% to some of their clients. And on the flip side, they're actually pausing some of their loans. They're not lending as much as they are, really trying to bring back as many of those depleted funds as they can.
All right, Bloomberg's Kriti Gupta, thank you so much. And now with a look at some other company stories we are following and looking at the moves in free market trading here in the U.S., we have to talk about marijuana and pot stocks, because the Safe Banking Act, which would make it easier for legal operating cannabis businesses to bank in the United States, is not going to make it in that must-pass defense spending bill. Remember, yesterday we heard the Senate Minority Leader Mitch McConnell talking about criticizing Democrats for trying to force that to be included in that bill. It will not be. So after falling between 13 and 16% in yesterday's trade, we are seeing losses continuing for some of those stocks, including Tilray and Canopy. They're down about 3% and 1.7% respectively. It is also a decline for another stock, Airbnb, getting downgraded at Morgan Stanley. The analyst pointing to slower listings growth as well as weakness in demand for night bookings. So as a result, Airbnb is down about 3%, but a much more positive story for MongoDB. This is a database software company absolutely soaring in pre-market trading after a beat and raise quarter. Analysts pointing out how rare that is in a weak macro environment, but this company clearly doing well. The stock getting rewarded up 27% before the bell, Anna.
Fascinating name. Kaylee, coming up on the program, we will turn to the macro stories dominating the conversation as we head towards the end of the year. Nicola Mai joins us, PIMCO portfolio manager and sovereign credit analyst. What opportunities in fixed income right now? And we'll also talk politics. Terry Haynes joins us, Pangea policy founder. A lot to talk about in the wake of that Georgia runoff, but also the broader picture heading into next year. Plus, the world's richest family is getting richer. Today's Big Take story takes a look inside the secretive Gulf family and their $3 billion fortune. Look for that online or on the Bloomberg terminal. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. you can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer today on Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both TV and radio. If you're listening this morning on Bloomberg Radio, I will walk you through a chart that, to me, is pretty shocking. Oil has completely erased its 2022 gains. In fact, at the low this morning, we're looking at a price that we haven't seen since December 21st of 2021. And that in the face of a reopening of sorts in China, at least backing off from the COVID zero policy. You would expect that means demand is going to pick up big time. So why are we seeing this commodity so linked to global growth drop in price? Joining us to talk about this and more is Nora Melinda, Bloomberg Equities reporter. Nora, it does seem like people are much more worried about a recession now in 2023 than they are optimistic about the potential for China to contribute to global growth.
Yes, there's definitely a lot of uncertainty in the market right now. Of course, we've seen more distress. And specifically yesterday, we heard from a lot of major banks, from Jamie Dimon saying that this could be a mild to hard recession, to Lisa Shallop
That's a broad, mild to hard?
Mild to hard, right.
But a recession could be nothing and it could be everything.
A recession is the operative word there, Matt.
Definitely. But, I'm really interested to hear from asset managers and retailers because, of course, we know that these major banks are hurt right now. They're doing a lot of, $1,000 cuts to bonuses. So I think that it'll be interesting to hear the perspective of people who are also directly involved with these investors on a day-to-day basis and see what they think. I think there's a lot of mixed sentiment right now.
Well, we know that for 4 days in a row, investors have been selling U.S. equities, quite a losing streak for the S&P 500. When you look at the different data coming out of places like Bank of America when it comes to flows, what does it suggest about where people are putting their money right now and where they're pulling their money from?
Yes. So Bank of America, we've been looking at the client flows, really interesting. So institutions are actually buying right now, retailers are selling, and institutions, we think of them as smart money. They're actually pouring their money right now into growth stocks, some of the most beaten down stocks this year. So I think that that's really interesting to look at. And also Bank of America has mentioned that the next 2 months tend to be the strongest when it comes to equity inflows, January being the strongest in particular. So I think we'll just have to wait and see what moves in the market ahead.
Yes, and some of those moves in the market, good morning to you, Nora, could be dictated by next week's data. We get quite a lot of data, not to mention some meetings as well.
Yes, next week will be a very, very busy week. Of course, we've got the Fed meeting, and right before that, we're going to get CPI data, which will be a really important print, just to see whether or not inflation will remain sticky or if it's calmed at all. So, of course, all eyes across the market are looking toward that meeting and seeing whether or not any of this data will impact what the Fed decides to do moving forward.
Yeah, feels like we've got one more week maybe until
almost
the end of the year. Nora, thank you very much.
Almost there.
Bloomberg's Nora Melinda helping us get towards the end of the year. And for more market analysis, check out MLIV Go. The function on your Bloomberg takes you to the Markets Live blog, where they will also help you get to the end of the year. This is Bloomberg.
policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of a solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Secretary of State Antony Blinken says the U.S. had no role in Ukrainian strikes inside Russia. The Kremlin has accused Ukraine of carrying out drone attacks that were the deepest inside Russian territory since the war started. Ukraine has not claimed responsibility. Two of Donald Trump's companies have been convicted in a criminal tax fraud trial in New York. They were found guilty of engaging in a scheme that allowed executives to evade taxes on company-paid perks for more than a decade. The former president was not charged. The prosecutors told the jury he knew exactly what was going on. And President Biden celebrated TSMC's plans to increase its investment in Arizona to $40 billion and build a second chip-making factory. The president toured the Taiwanese company's facility in Phoenix. Companies such as Apple are eager to buy more chips made in the U.S. and, of course, Anna, reduce their dependence on China.
Yeah, absolutely. That got a lot of coverage, didn't it? That visit yesterday, just how significant it is. Really interesting analysis by our opinion team over in Taiwan to dig that out on the Bloomberg terminal. Coming up on the program, Nicola Mai, PIMCO portfolio manager and sovereign credit analyst. What does he make of the pivot into bonds that we're hearing a lot about from some managers? This is Bloomberg.
nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
We'll shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Democrats get a big win. Senator Raphael Warnock defeats Republican Herschel Walker in the Georgia runoff. China makes a major shift from COVID-0. Beijing eases restrictions in an attempt to boost the economy and quell public discontent. And job cuts on the way at Morgan Stanley. Bloomberg's learned the bank will eliminate 1,600 positions. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Matt, European equity markets, US futures, all weighed down perhaps by, well, some of the same themes of yesterday. Fears about the extent to which we'll see recession in the United States next year.
That's right. It seems as though all the bank CEOs that we spoke to, that Shanali Basak talked to at the Goldman Sachs conference, were so pessimistic that the market is now concerned about a recession, more concerned than it was the day before. We saw a big drop in the cash trade over the last couple of sessions, and now futures are down about 0.3%. We have investors buying 10-year debt right now, pushing the Treasury down to 352.94. This coming off a high just over a month ago of 424. So yields have really come in here. And NYMEX crude is off 1%. I think this is the most striking move. We have been down under $73 in this session. And this as we see China reopening or reducing its COVID-0 policy, backing off of that. You'd expect the demand out of that massive country to drive the price of crude up. On the other hand, recession fears seem to be weighing on the price, pushing it downward. And then I put in gold, which I think is really interesting because of a Zoltan Pozsar note yesterday, the strategist saying that there's an outside possibility after the European price cap, or a Western price cap, I should say, on Russian oil, that Vladimir Putin instead demands gold for crude, and that pushes up the price of the shiny stuff and weighs on the dominance of the dollar. Now, I think a lot of people feel that's a very outside possibility, but it's still interesting to think about, and as a result, we're looking at gold right now, $17.72 a troy ounce. Kaylee, what do you see in terms of the U.S. markets? The pre-market movers.
Well, it's interesting. You were talking about the China story, Matt, and how in theory the dramatic almost reopening and easing of restrictions in that economy when it relates to COVID-0 should give a boost to Chinese stocks, maybe, but that was not the case overnight, and it's not the case for those ADRs here in pre-market trading this morning. The likes of Alibaba and JD.com actually down pretty substantially to the tune of about 5 to 6% each. But remember, these stocks absolutely ripped in the month of November in anticipation of a relaxing of some of those curbs. So perhaps all of that good news was priced in already. Maybe that's what's going on here. I would note as well that it isn't just Chinese technology stocks and their U.S. listings under pressure. It is U.S. technology stocks as well. well. Tesla down 2.3%, and Apple also down about 0.9%. So big tech obviously dragging on the broader market this morning, Anna.
Yeah, and Kaylee, is the China story also failing to lift sentiment here in Europe as well? We're down by 0.7% on the Stocks Europe 600. So the longer we spend trading here in Europe, and we're now 2.5 hours into our trading day, the worse things seem to get. So moving a little lower this morning. Brent crude also not getting a boost, to Matt's point, from that China story. 78.42 is now the handle, 78 the handle on Brent. So despite the reopening narrative, despite the fact that we get day after day further moves from the Chinese authorities, and these latest ones seem quite substantial and to be quite national as opposed to very regional, that's not having an impact in today's market, at least. We'll see what happens from here. This is the natural gas price here in Europe, heading a little bit higher. We've received some forecasts that suggest that the next few days could see some really cold weather in the UK and snow and all of that. And that at a time when the wind turbines are not really going to be spinning as many people would have hoped. So that could push gas prices higher, and that we're seeing a little bit today. GlaxoSmithKline, GSK, up by just shy of 9%. I could have put in here, and I did last hour, Sanofi. Could also have talked about Haleon, Matt, which was the consumer arm spun off from GlaxoSmithKline recently. The reason these stocks are rising is the same reason that they fell, or the opposite of why they fell in August by a substantial amount. And that's because in August we saw a legal case brought against them, and which the scientific arguments behind have now been thrown out by a judge in the United States. It was all to do with whether Zantac produced cancer, and the judge says that the scientific arguments are flawed, and so has thrown out this case. So that's why we're seeing this sort of relief rally, if you like, in the producers of the branded and the unbranded generic versions.
All right, very interesting stuff, and we're going to continue to follow those movers. Right now, though, I want to talk about the broader market with Nicola Mai, PIMCO portfolio manager and sovereign credit analyst. First off, Nicola, I want to get your take on the pessimism that erupted yesterday out of Wall Street CEOs. You can see it in the drop in equities over the past couple of sessions, and really in the drop in the price of a barrel of oil. Why do you think, as we continue to report these incremental changes in terms of China reversing its COVID-0 policy, that we have crude dropping to a level we haven't seen since 2021?
Well, I'm afraid I kind of agree with the pessimism that was shared by some of the colleagues in the market. Our expectation is for a recession in the coming quarters in Europe, but also in the US. And I think, the purchasing power squeeze on households from higher inflation, the significant tightening in financial conditions, record low sentiment, I think, mean that contractions in activity are very likely in coming quarters. I mean, you're right that the Chinese news on balance have been positive, the relaxation of property regulations, as well as the prospect of a reopening from the COVID restrictions. But I would just remind that a proper reopening is unlikely to happen until the second quarter of next year. I think it's going to be a gradual process. Cases are high. There's still a tendency to keep restrictions pretty strict. So it will be a lift, and eventually in 2023, China could even outperform expectations. But I think in the near term, the prospects are not that good. So if you look at oil prices, I think they're reflecting that in a way.
They're reflecting that, yes. And we talked to a number of economists. I know we did a survey at Bloomberg that suggested the timing you quote there, Nicola, is quite a sort of common assumption around the second quarter of next year for further real reopening. So if we are heading towards a recession in the broader economy, the global economy, certainly in the US anyway, it seems to be the thinking of yesterday, do you like bonds? Do you like the bond markets, and which parts of the bond market if we're preparing for recession?
Yeah, I mean, I think bonds offer a pretty compelling investment right now. I mean, you can take 2-year duration risk in the US and get a yield of 4.35%, which is something you couldn't have dreamed of, a few years ago. I think yields are higher across maturities. Obviously, as you go into recession, you want to stay in quality. So first of all, I think that the rate peaks priced in the market for central banks are broadly appropriate in terms of being enough to bring inflation down over time. So that means that government bonds are pretty attractive at these levels. And if you look in the corporate space, obviously you need to be careful because, as I said, we're entering recession, so you want to stay away from default remote names. And our bias is to stay in the higher quality spectrum. And there you can get some high quality default remote bonds for 6-7% yields, which honestly are quite attractive, especially in an environment in which equities continue to look quite expensive relative to the macro outlook.
Well, Nicholas, so much of the narrative coming into this cycle was that not only was the consumer healthy, but corporate balance sheets were very healthy as well, so that default risk seemed like it was relatively lower than it has been in cycles past. Why not be willing to take more risk on that front then?
No, I mean, I think you're right that there is already a decent amount of defaults priced in the credit markets, and after all, we do expect a recession, but a relatively mild one, because of the lack of imbalances that you mentioned, both in the household and in the corporate sector. You know, having said that, when you enter a recession, you know, the vulnerabilities do show up. The fragile companies are the ones that are going to be hit the most. So you want to be selective. And I think especially as you enter a recession with some uncertainty on the depth of recession, I think you're better off staying in the higher quality space, where, as I said, you already get pretty attractive yields. Having said that, if you do your bottom-up work, there will be some high-yield names where it's worth investing, but I wouldn't more broadly focus on the lower quality at this point.
How much risk, Nicola, do you attribute to the Fed doing too much, hiking too much? I spoke to a guest earlier on who was saying that he'd been looking at the rate at which M2 was pulling back to the money supply and suggesting that this did look quite unusual and that there is really a risk that the Fed goes too far here. How would you assess that risk?
Yeah, I think the Fed has a really difficult job because monetary policy, you can only see the effects of monetary policy with a lag. I think Larry Summers had a great quote where he said, you know, moving interest rates is like turning the tap in the shower of an old hotel. You only know if the water is too hot after a while. And I think that's the situation the Fed is in right now. You know, I think broadly speaking, the tightening in financial conditions we've seen looks broadly appropriate, and it makes sense for central banks, including the Fed, to slow the pace of tightening at this point and witness the effects of the tightening. I would say that you know, it's possible the Fed will have to go a little bit beyond market pricing from here, but I would say not a lot beyond that, given what we're seeing in activity in the interest rate sensitive parts of the economy and in the financial markets. You know, I think we're pretty close to what will likely be the peak in terms of policy rates, in terms of what's priced in the market.
Okay, Nicola, thank you very much for your time. Nicola Mai of PIMCO, thanks for coming to talk to us. Coming up on the program, we will have more on the Georgia runoff. Terry Haynes joins us, Pangea Policy founder. We'll look at policy making in the year ahead stateside. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Well, on the subject of U.S. domestic politics, the Democrats have narrowly retained Georgia's Senate seat, giving them an outright majority in the U.S. upper house. Senator Raphael Warnock defeated Republican challenger Herschel Walker in the state's hotly contested and expensive runoff election. Joining us now for more is Terry Haynes, Pangea Policy founder, who is up early for us here on the East Coast. Terry, thank you so much for joining us. 51 seats in the Senate, so maybe an individual like Joe Manchin has a little bit less power, but what difference realistically is this going to make?
Good morning, Kaylee. Realistically, I think it means almost no difference, frankly. Democrats had effectively 51 seats before by using the vice president's tiebreaker. So now you get a clear 51. There's a lot of crowing that this means different results on committees and the like. What you got to remember about the Senate is that it's not really as much an organized political body as it is 100 CEOs, all of whom have to be accommodated, or at least 60 have to be accommodated on the Senate floor in order to get anything done. So that's not going to change a whole lot, whether it's 51 or 50, frankly.
Does this, though, limit the ability of someone like Joe Manchin to stop the Democrats' legislation agenda?
No, I don't think it does, Matt. And the reason why is that it's not just Manchin and it's not just Sinema. You've got, I'd say a half a dozen members, others who are not inclined to be as public as Manchin or Sinema. They don't want to take the political heat at home or nationally for a lot of things, but yet they'll step up on a variety of things. I think it's always a mistake to think that Manchin's representing only himself or that Senator Sinema is. What you're going to find is that it's very, very difficult still to put together 51 votes for anything on final passage, but more importantly, 60 votes on pretty much anything on the floor. So, net, what you still have is you've still got a Senate that's very, very difficult for Senator Schumer to even control his own side. And of course, you've got divided government. So that means negotiating with a nominally Republican House that's got its own problems on trying to keep its side together.
So what calculus does this then change, Terry? I mean, with 50 already, the Democrats could stop a conviction of a Biden impeachment. Why does it matter if they have 51?
It doesn't so much. It's good political hype to talk about having absolute majorities. It's a good way to talk about your achievements and having a good and unexpected midterm result if you're a Democrat. But net, this really doesn't change a whole lot. You've still got to cobble together votes. You've still got to come up with policies. And I'd say the net effect is that for the current situation in Washington overall is that it makes centrist job easier on some things, but it makes companies and interest groups tasks harder on other things. Let me give you a quick example. On financial services, for example, well, you've already seen centrists push back against Biden progressive nominees in places like the Federal Reserve, bank regulators like the comptroller and the like, and defeat those sorts of nominations. So that's a triumph for centrists. But on the other hand, it's going to be that much more difficult for the financial services industry, say, or tech industry to try to use Congress as leverage against regulators because there frankly won't be consensus one way or the other on those things.
On the international front, Terry, does it look like harmony? Does that look like parties will be on the same page on all the important international policies ahead?
Well, I'm glad you bring that up, Anna, because my view of the next Congress, very simply, is continued domestic gridlock, continued fiscal harmony, grudging harmony on the things that basic things that matter on government funding, but unanimity on international. What you're going to see, whether it's Democrat or Republican, is you're going to see the continuation of great consensus on issues like Russia, Ukraine, and China. And I think those are all very good. Certainly for those who care about the United States position, that's very good news.
Terry, just quickly, as we look ahead to 2024 and a man who has already declared his candidacy for that presidential race, former President Trump, he obviously backed Herschel Walker. He backed many candidates in the midterm elections that did not win their races. Is this about the former president backing candidates that are flawed, or candidates being backed by a flawed former president who is losing his grip on the Republican Party?
Yeah, I'd say the second. Your second is very well stated. I wrote a couple of weeks ago that I thought that former President Trump had jumped the shark in political terms, and that's both because of electoral performance. This is someone who's now seen as a serial loser, between 2020, 2021, 22 midterms, and now Georgia, and these increasingly outlandish statements about suspending the Constitution, as well as his very ill-timed presidential bid announcement coming after the midterms. My view of the Republican Party is they've been looking to try to figure out how to get past Trump for some time, and that's been ongoing. But that work accelerated greatly after the midterms, and I expect that to continue. I do not expect President Trump to be the nominee of this party in 2024.
Terry, thanks very much. Thanks for your analysis. Terry Haynes of Pangea Policy bringing us an update on U.S. politics. Coming up, Francisco Blanche of Bank of America Global Research joins Bloomberg Surveillance to talk oil demand as China begins to ease its COVID rules, not having an upward input onto the oil price. So today, 78.70 is where we trade on Brent, down 0.8%. Analysis later. This is Bloomberg.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
it means they have a Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London. Now let's get to Credit Suisse. The story of the day is that the wealth management unit is trying to claw back some of those $90 billion in assets that have been lost by offering higher interest rate products and higher yield notes. For more, Bloomberg's Marion Halftermeyer joins us out of Zurich. So, Marion, I was excited to read this story. It looks like they're offering like a 7% CD, which is a huge rate.
It's pretty interesting. It definitely is. You definitely see some of the efforts that they're trying to make to bring clients back to the bank. You know, some of these products aren't necessarily unheard of. Many wealth managers use these types of incentives to bring client assets in before the end of the year to show, you know, good AUM for the year. But yeah, it's an interesting interest rate, certainly. I'm not sure it will convince clients to bring back the 80 to 90 billion that they've taken out.
Right, yes. I was going to ask you, Marion, how successful is this push expected to be then?
Look, I think you have to take it into the broader context. The bank is obviously still having to prove itself. The restructuring plan has just started. They're going to be really making a lot of the moves that they've announced in the next year. So it's still not clear, you know, exactly how the bank will progress. And I think that for a lot of clients, that's going to be keys, seeing, you know, what the bank looks like next year. So I don't necessarily think that they're going to be bringing all that back before the end of the year. And, you know, executives and people we've spoken to have said as much. You know, they know it's a long haul that will continue over the next couple of quarters.
Marion, who realistically is going to be left to bank for these people, assuming they do come back to Credit Suisse?
From a talent perspective, it's a question. I mean, that is top of mind for a lot of the relationship managers and the private bankers. You know, they are worried about whether or not they will even be at the bank next year to service the clients that they're trying to get to come back to the bank. So it's a bit of a weird conundrum. But that being said, you know, the executives have said that most of the job cuts that they plan to be making, and that's 9,000 tops for the next 2 years, will come more from an operational side of things, from IT, ops, those types of people, rather than really the front-end business.
All right, Bloomberg's Marion Halftermeyer in Zurich, thank you so much for joining us. Now let's take a quick final look at what is coming up for the rest of today as we wrap up Early Edition. At 7 a.m. Eastern, we will get U.S. MBA mortgage applications. Then at 9:30 a.m., ECB Executive Board member Panetta will be giving a speech at the London Business School. The ECB, of course, holding a meeting next week along with the Federal Reserve. Plus more central bank action later. At 10 a.m. Eastern, we get a rate decision from the Bank of Canada, followed by Brazil at 4:30 p.m. Brazil is expected to keep its key interest rate steady for the third straight meeting. And Anna, really, it just feels like as we watch these central banks today, we're all just waiting and holding our breath for CPI next week and the Fed the next day.
Yeah, absolutely. We get CPI next week, we get the Fed, Matt, we get the Bank of England, and then it feels like that'll be the last week. Is that it then, Matt? Are we all done for the year?
I think we need at least another 50 basis point hike following this coming one in order to get to 5. And then the question is, how much further does the Fed go, and what kind of damage does that do to the economy? It looks like that's the equation that the market is trying to figure out today.
That's the big question. Those are the treats that remain ahead then for the new year. That is it for Early Edition. Surveillance is ahead with Tom, John, and Lisa. They'll be hearing from Chris Barone of Stratogas Research, among other voices, of course. This is Bloomberg.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Inflation is too high, and I will contend that this current inflation battle is not one-off.
The likelihood of a soft landing is quite low.
The idea that we're going to have a soft landing means that so much of the data would be historically unique.
No one is placing big bets yet that we'll see this miraculous second half rally, but certainly that's the sentiment.
The only thing that we can be sure about is that this is going to be a really choppy ride.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures slightly lower this morning, down 0.2%. Another day of losses in yesterday's session. And TK, warning after warning from Wall Street chiefs.
Guys, I think we begin a 10-day week. It's not a 7-day week, a 5-day work week next week. It begins today to get out to that Fed meeting next week and beyond. And what I see on the screen, summing it all up, is one large recession call. There's no other way I can get there in equities, bonds, currencies, commodities. It's about the modeling of recession.
So David Solomon of Goldman told Shanali bumpy road ahead. JP Morgan's Jamie Dimon was speaking yesterday as well.
Are they talking their book?
He said mild to hard recession is something we could face in 2023. And you said recession call across the screen. Let's go there in commodities. Bremo, crude, negative. Can we just sort of sit on that for a moment? Oil is negative in 2022. Can you make sense of that?
You're just trying to wind me up. I know you are, because you know how I feel about this.
It's Wind Up
Wednesday. Yeah, exactly.
Wind Up Wednesday.
It doesn't make any sense to me, because we're seeing China potentially reopen. We're seeing the likelihood of data coming in more, accelerating more quickly than people had expected. Everything is still going. So even if we get that recession, it's not there yet. Why are oil prices the lowest in about a year? It does not make sense to me.
Energy equities, Tom, still up more than 50% on the S&P.
Yeah,
today.
We've got a bunch of guests to talk to about this, including Francisco Blanche after Ed Morse yesterday, and Mr. Verone here in moments anticipated to say the least. I don't know what to make of it, other than there's a gaming out that at some point oil reverts back up to where many people feel comfortable that it should be $100. $100 a barrel is a long ways away right now.
Right now it's in the low 70s on WTI. Your equity market's down about 0.2% on the S&P. Over the last week, 4 days of losses on the S&P 500. We've had losses every single day since the day after Chairman Powell spoke. And Tom, we've taken out those Brookings gains over the last 4 days, back to where we were before Chairman Powell spoke last week.
I mean, any number of days. I want to get this out because I think it's so important. You mentioned the economist James Dimon, the economist Mr. Solomon. Can I note that Jan Hatzius is polar opposite of his boss, and there is a Hatzius Solomon distinction.
How wide's
here.
the spread?
The spread here is like energy stocks and crude oil. Jan Hatzius has a non-consensus call. Basically, he's saying, everybody calm down. There will be disinflation. There will be adjustment. And his probability of recession is to the optimist side of Solomon.
You're trying to cause trouble downtown.
I am. But you know, Mr. Solomon, I know you watch every morning. Jan Hatzius gets it done. So let's be sure.
Snarly Bassett coming up a little bit later to break down some of these comments, Lisa. And we got a ton of them in the last 24 hours.
And really, the question to me, though, is how much are they basically laying the groundwork to lay people off around the edges? We didn't even talk about Morgan Stanley laying off about 1,600 workers, about 2% or a little bit less of their workforce. So that might be underpinning the tenor of some of those conversations. I don't know, just a sort of hunch. 10 a.m., this is what we're looking at. Bank of Canada rate decision. It has been a leading indicator typically of how other central banks are going to move. The expectation is for a 25 to 50 basis point rate hike. It's 7th consecutive rate hike, but it could indicate perhaps that they're starting to get to the end of the cycle. Those two-year yields, honestly, rising to the highest levels going back to 2008. You've seen that overnight rate also reaching up around there and staying there for the past couple of weeks. 10:30 a.m., EIA crude oil inventory report. The supply-demand dynamic. How much are inventories low? Does this give us any picture as to why oil prices are so low? If inventories are low, that means that oil prices are vulnerable if perhaps demand picks up to have a dramatic increase. This is where I just don't understand because oil inventories have been low. So again, I'm not really understanding the fundamentals and how price dynamics really fit into that. And I'm sure I'll get a lot of hate mail. I've been getting a lot of hate mail throughout the morning. Keep it coming. I love it. 3 p.m. we also get October U.S. consumer credit data. How much are people borrowing at this point, heading into more difficult periods with respect to disposable income? And John, that's been a big question. We've seen those borrowings go up even as delinquencies start to tick up just a little bit. How much can this mechanism continue to provide a buffer for a consumer that has otherwise been incredibly strong?
I don't believe that anyone sends Bramo hate mail.
Oh, I get it. It's fun.
No, I get the hate
I actually like it.
Ken Pruitt got the love notes, and now Lisa gets the love notes. It's just
that's what I thought too. Who would
it's
send Bramo
abusive.
hate mail? That's a disgrace.
Yeah.
Chris Ferrone joins us now, partner and head of technical and macro strategy at Strategas, Baird Company. Chris, you know how I'm going to frame this question, and we can sort of dissect that in just a moment. Crude's down on the year. Energy equities are up more than 50% on the year. Chris, what's going on?
Well, let's remember that's also after being up like 60 or 70 last year. So the 2-year turn on crude is certainly not what we've seen out of the equities. And I would just make 2 quick points. I'd say number one, let's disassociate the spot from the forward curve. You've seen new lows in spot over the last week or so. The forward curve has actually not made new lows. I think there's a realization as you go toward the out months that there are still some structural deficiencies in the crude market that are reflected there. And second, as oil has come down this year from roughly the 130 highs in February to where crude presently trades today, energy sector credit has not weakened. That is such an important difference from, say, 2014, 2015, when crude was under pressure, the credits were also deteriorating. That has not been the case here. So I think the market, at a minimum, is suggesting, hey, maybe it's not the energy stocks that have it wrong here. Maybe it's the price of oil that has it wrong here. And I think it's always interesting, John, how the question is always phrased, do energy stocks have to catch down with oil, not does oil have to catch up with the energy?
Within that, Chris, and let's go CTA right now, because I think this is so important to global Wall Street and the shock of the moment. It is a set of lower lows, of lower highs. The technical charts I'm looking at on the terminal of West Texas Intermediate are grim. They harken back to, not to bore people, Earl Blumenthal in 1949 and point and figure double high pole tops. It's a grim chart, Chris. How do you know when to get on board crude oil?
Yeah, I would just encourage you, Tom, take a step back and look at the 10-year chart or the 20-year chart. There is so much support on spot WTI, somewhere between 65 and 75. So we're kind of right into that range where I think, on a weekly basis, we're borderline oversold here. I think we're, in the general vicinity or ballpark of ultimately where this will bottom for the next several years. So listen, the move's been 130 to 70. That's been the move over the last 6 months. I think if one's getting on board now with the sell crude or short crude call, they're late.
Did he just say load the boat on oil? Were you taking notes?
I'm not sure if you went that sort of far, Tom.
Did he say load the boat?
Load
You
the
know,
boat.
Load the boat?
what I'll add to this discussion, though, is what I'm perplexed by is there's this, very persistent narrative of peak inflation. Inflation will come down next year, but look at the performance of some of these basic resource stocks over the last month or two. Things like Rio, BHP, Glencore, stocks that were largely on the mat all year have really woken up over the last several months. So there's something going on there that I think is in contradiction to this very popular consensus narrative about peak inflation.
So let's talk about that. And basically, are you saying the market is wrong and that this is actually something to lean against, and that there actually could be a broader point here, that people have bought into a recession story so much that they're ignoring fundamental data that perhaps flies in that face, at least in the short term, perhaps not in the long term?
Oh, quite the contrary. I'm not suggesting the market's wrong here. I'm suggesting that I'm offering that the consensus might be missing some clues the market is dropping to us. And I would highlight three of them over the last few weeks. Number one, as we just talked about, these big basic resource names have woken up. I would say number two, look at Chinese 10-year yields. I mean, Chinese 10-year yields have been falling for 2 years. Those have stopped going down. I think it's an important change. And then third, really important, gold here has started its bottom. Gold's waking up. So there's something going on here. And we talk about, what's the next card the dealer will reveal? Well, there's three of them, I think, that are very important of how we want to think about 2023 and beyond.
Rio, up 23% in November. BHP in London, up almost 25% in November. Chris, I'm seeing the same things that you are. Those miners have had a big rally, and I think a lot of people would attribute that move to what's happening in China. Chris, what do you make of what you're hearing about the China reopening? Just a long list of easing recommendations from authorities this morning. What's your take on it all?
I'd make a couple of observations here. I would say, number one, the move in Chinese yields over the last, let's call it 6-8 weeks, I think is pretty significant. Now, we've seen data that the Chinese are selling bonds to buy gold. I think that's certainly relevant here. But as far as what the proclivity among investors is when they get this sense that China wants to reopen, I would fight the temptation to go back to the old China stocks, the KWEB, the China Tech, the Tencent, the
Connection lost.
I think the message is, as you just mentioned, John, it's Rio, it's BHP, it's Glencore, it's iron ore. That's where I think the money can be made in some type of a China reopen over the next number of quarters.
Hey, Chris, wonderful to catch up. Always great. Chris Verone there, Strategas, a bad company. We appreciate it. I think we've got to ask the question, haven't we? Are Chinese authorities about to drop COVID zero, or are they just making these restrictions more palatable for the people after the protests we saw a couple of weekends ago? Going through the 10 new measures. We've broken this down on the Bloomberg terminal. You can find it on Bloomberg.com as well. Lisa, here's one. Be precise in categorizing high-risk areas, limiting them to residential units or blocks, and refraining from extending them at will to an entire housing compound, neighborhood, or street. That doesn't feel like let's drop COVID zero. That just sounds like let's make it less harsh and more palatable for people.
Especially when you look at mobility data, when you look at trade data, when you look at other signs of business activity that aren't really picking up that quickly. How much is this actually relaxing in COVID zero policies? Also, there was this company, this analytical company that the Financial Times reached out to that actually provides the Communist Party with bottles and said that perhaps 1 million people could die during the winter if they opened up right now. How much is that going to be the justification for not doing just that?
Well, I wonder what the lessons will be from the West, Tom, just in terms of the stop, start. Do you remember the reopenings here? Stop, start, then lock down again?
Yeah, but
I remember seeing that in the UK repeatedly.
They were wrapped around science, and there's a big flip here in that the way in America older people were vaccinated, in the West, I should say, older people were vaccinated, where I believe in China it's the opposite. So you've got a hugely vulnerable public.
And questions about the efficacy of the vaccine as well, Tom.
The efficacy of the vaccine to me is front and center. You wonder if we can provide leadership to help them help themselves.
And I get, it's the market's job to anticipate and all of that, but we're just breaking down the incoming information.
I thought you said this is a quiet week.
Meant to be.
It's meant to be.
Supposed to be.
I just see recession on the screen as one.
I'm always referring to the schedule. The schedule next week is busy. CPI next week, Federal Reserve decision, ECB call as well.
Can we do in the other room where we got a bigger room, can we set up a soccer goal so you can teach us how to kick penalty kicks?
Would you like
that? Yeah.
Should we get a professional here?
Yeah.
And, some goalposts. We used to put sweaters
How hard
down
is it to do penalty kicks? I mean,
I mean, the Spanish made it look difficult yesterday.
I've never
Wasn't that a
seen
mess? That's some
anything
of the
like
worst penalties I've ever seen.
Ever
in a penalty shootout.
Ever.
From New York City this morning, good morning to you. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Incumbent Democratic U.S. Senator Raphael Warnock has won re-election in the Georgia runoff. Warnock defeated Republican Herschel Walker with a little more than 51% of the vote. Walker had been handpicked by former President Trump. Warnock's victory allows Democrats to hold a real majority in the Senate with 51 seats. In China, it's a major shift from the COVID-0 policy. Today, Beijing eased a range of restrictions aimed at preventing transmission of the virus. They included allowing some people to quarantine at home instead of in centralized camps. Plus, authorities have scrapped virus tests to enter most public venues. China's government has been under pressure to change its approach. In Germany today, more than 3,000 law enforcement officials conducted raids aimed at breaking up what authorities called a coup attempt. According to prosecutors, they detained 25 people linked to a far-right terrorist group that wants to overthrow the government. It's called the biggest ever raid targeting right-wing extremists in Germany. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. No one covers the world like Bloomberg.
My team thinks 2023 we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
I feel that right now things are going in the wrong direction.
Yeah.
We're entering a recession in most advanced economies, starting with the United Kingdom and the Eurozone, also in the United States, not enough. And inflation is still too high. So we're entering a stagflation like we've not seen since the 1970s.
The brilliant Nuria Rabini there, Chairman and CEO of Rabini Macro Associates, catching up with Francine Lacqua a little bit earlier this morning. Live from New York City, let's give you a flavour, a snapshot of these markets. 4 days of losses on the S&P. Longest losing streak back to early November. This morning we're down a couple of tenths of 1% on the S&P. Down about 7 or 8 points on the S&P 500. Yields going nowhere this morning, at least on a 10-year, 353.31. Euro dollar, brief break of 105 and then back to 104 again, 104.91. We are positive there, 0.2%. I want to finish on crude. Crude this year is just, what a wild ride for WTI. 73 this morning on crude. We're down about 0.8%. And if you are just tuning in, we are negative for the year on WTI, which is just unbelievable.
buried in the news yesterday, John, EIA out with supply and demand tweaks as well, but the major tweak is demand just has not come on, as Edward Morse, the Citigroup, mentioned yesterday. He was
congrats to Ed Morse.
Yeah.
Fantastic call earlier this year.
Francisco Blanch with us here to give you perspective on $3.88 a gallon. This is an important conversation now, and it is off the American radar. Emery Horton will join us, yes, on Georgia, but far more, a changed Maria Tadeo in London over what happened in Ukraine and 90 miles from Moscow yesterday. Think, folks, in New York City, somewhere between East Hampton and Southampton, there was an attack. Maria, to me, it's completely changed. These drones, it's drone warfare, and I don't think America understands this morning. This was within miles of Moscow.
Tom, you nailed it. The nature of this war has changed. We talked about the winter war. We talked about the cold in Ukraine, the idea that Vladimir Putin wants to break the will of the Ukrainian people. But the other fundamental issue, and you nailed it, is the drones. The drones going both ways, Ukraine to Russia, Russia to Ukraine. This is now changing. And by the way, I hear from my contacts that today European officials will debate new sanctions to try to strip the ability from the Russians to come up with drones. And then when it comes to Ukraine, the question is, how close can they get to Russia before this is perceived as a serious escalation? So yes, Tom, you nailed it. This is now a drone war. The nature, again, of this war is changing, is shifting.
The defenses here go to Israel and what Saudi Arabia does with attacks from the south. Can either party defend against drones?
At this point, if you talk about this full air defense system that will essentially allow you and protect you to not be hit 100% ratio, that is not the case. When you look at Ukraine, they say we are successful when it comes to maybe 70, 75%, but it's not 100%. And that has been the issue throughout in the past few weeks. They continue to hit the country, but also the energy infrastructure. And that's the problem, Tom. They just don't have the time to fix, have it broken, and repair it again. That is a problem. They do not have 100% protection.
Anne-Marie, this really raises an issue going forward because this war is not ending. And people wonder what this means for the energy backdrop at a time when oil prices are actually falling. When you see energy prices, even in Europe, have been falling. They've trended up just a little bit recently. At what point does the U.S. administration say it is time to start buying oil to stockpile the Strategic Petroleum Reserve ahead of what could be a messy year next year?
Well, I think they probably see how prices are going to shake out the next 3 to 6 months. But when you get to WTI in a $60 to $70 range, that is something I think the administration will look at and say, okay, now is the time to try to replenish, especially after they have this drawdown. Where the SPR is right now, we haven't seen that level since the 1980s. So that would be the opportune time, especially if they're concerned about what happens in the future. But the issue with the market right now is there's so many unknowns. We have China, of course, kind of hinting and whispering about potential easing, but these are very light touches in easing. And that's why this meeting happening with Xi Jinping and Mohammed bin Salman this week is so important to the oil market, because the Saudis, as much as the rest of the world, especially since their crude is going there, wants to know when potentially we could see demand. And really, it's the demand picture. And then there are a number of other questions. I mean, we put to bed some of them in terms of this week with the Russian oil price cap, but what everyone is asking, European, U.S. officials, people in the industry, what they want to know is what happens next with Russian products, jet fuel, naphtha, diesel. Is there going to be a cap on these? There's so many unknowns.
Okay, Anne-Marie, there's a whole lot here, right, including the Xi Jinping and Saudi Arabia ties, and we see that trip happening today. We just had an election. The Democrats now have 51 to 49 in the Senate. Why not start buying oil now? That is over. If gasoline prices go up, it isn't the same political liability for another 2 years, and the prices are getting within the range. They said they'd start buying.
It's a great question, and maybe they will start buying, Lisa. I imagine for the administration, especially when you have David Solomon on Bloomberg TV yesterday saying that it looks a little bit bumpy for future oil prices, they might actually wait and see if they can buy at a more opportune price, at a lower price, especially if a recession is going to hit. Gasoline prices today are what, $3.30, 40 cents. this is a good place for them to be. But if oil prices are going to go lower, then they're going to wait. They're going to wait for as low as they can go before they start refilling.
Time now for surveillance correction. Yesterday, about 3:30 afternoon, I finally realized what young Pharaoh has told me for years. The camera came in and showed, I was shocked, John, the smallness of the goal in a penalty shot.
It's tough.
It's only 11 meters and it's 12 yards. I get that. I looked it up. But I think a lot of idiot Americans like me think you're shooting at this ginormous goal and you're not.
You just wanted to fit that in,
And
didn't
if
you?
you hit the post on the first penalty shot, you end up medicating Maria today.
Hey, guess what? If you miss the shot on the first shot, Tom, the goal gets even smaller as the stakes get higher.
Stunned.
Oh, the psychology of this. Maria, time now for some exclusive match analysis. What happened to Spain yesterday?
Look, this is very emotional for me, but there's three things I want to say. First of all, in football, like in life, you have to seal the deal. You can pass the ball many times. If you don't score, you're out. And we need to learn that lesson. Then secondly, I am tired of this conversation. Is it Real Madrid or Barcelona that carries Spain? When you play for Spain, you play for Spain. Basta. I don't want to hear this debate anymore. And then lastly, on a more personal note, I have to say thank you, because the amount of people that reached out to check on me, to send me their love, it was incredible. On social media, text messages, really this show, Surveillance, what an incredible community it is, and what a show this is. So I am very grateful, humbled, but I'm also very grateful for the love.
TK?
Mrs.
Would
Yeah,
you like,
please,
yeah?
please,
Would you like one?
please, over here
Sure.
on radio, please. It's very emotional. I didn't contact her.
You didn't reach out.
Please, it did.
reach out.
Folks, full disclosure, I did not reach out to today.
I was getting the live commentary.
Her mother
afterwards.
called and just
That
gave
was-
me holy hell.
That was deeply, deeply emotional. AMH, you were laughing through that.
I'm sorry. It's a little bit funny, and I love Maria and we're friends. But Maria comes on television and she goes out and she says the score. She says that they're going to win 2-1. And then she also kind of had a little bit of a dig at the American team. And I'm really into this young team, and I'm so excited for the World Cup in 2026. And I extend an invite to Maria to come watch the games with me around the United States.
With no time, just as quick as I can. Everybody seems to hate FIFA. What a success this thing has been.
It's turned out to be,
It's just amazing.
And the Final Four, potentially.
Your
could be
bracket
even more
looks better
interesting.
than mine, young Pharaoh.
Well, that remains to be seen.
Yeah.
We've got a final 8. Let's see what these Final Four shape up to be after the games on Friday and Saturday.
Saturday.
Yeah.
You going to join us?
Yeah, England, France.
10-2.
AMH is in town.
Oh, she's...
Yeah.
I don't know. Alan Ducasse with
Did you not get the invitation from Casaferro for the exclusive World Cup viewing?
No, I did not get that.
My people didn't send you the invite.
It's going to be a big bash, but you got to take your shoes off.
What a
first.
shock. You got to take your shoes off.
Shoes on are fine.
Yeah, but if you don't take your shoes
I'm not
off,
gonna-
then you're going to judge.
Maybe.
Yeah, that's really how it's going to work.
AMH, great to catch up with you. Maria Tadeo.
Thank you.
Thank you, Maria. That was beautiful.
It was.
Wasn't it? You know,
Hey, it's
this
what
is
it's
emotional.
about.
It's deeply emotional
Americans
for a lot
are
of
like, she's
people.
nuts, and
No.
this is, like, very
It's
cool.
deeply. I've cried at many a game, shed many tears over the years. Coming up, Francisco Blanche, Bank of America.
Just let that lie.
How about those Yankees?
Need therapy after that, don't we?
Seriously, seal the deal.
Future's negative. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer today on Bloomberg.
There are three things I want to say.
Oh, dear Lord.
Wasn't that brilliant? I'm still just
I've been doing
stunned
this
by
for
today.
22
Wasn't
years
that
at
fantastic?
Bloomberg. That was one of the single best moments in 22 years.
Just Maria today lighting it up on football.
And, seriously, it's the way you are, John, what I witnessed with the Tots, thank you, Mr. Levy, for letting me see a hat trick by Son, the Korean, but the way Maria is foreign to Americans, and it was just wonderful to see that.
Does Mr. Levy know that you call it the Tots, and is he happy about it?
Well, I've got mixed reports on that. Although I have him in my bracket for the finals.
That's good to
France,
know.
Argentina,
and the Tots.
Spain, and the Tots.
So who does Harry play for if it's Tots England?
It's up to him.
Equities right now look like this. This is ridiculous. We're down 1/4% on the S&P. 4 days of losses on the equity market. Will we make it 5? On the NASDAQ, we're down about 0.4%. Yields yesterday's 2s, 10s, negative 80-something basis points. We go deeper and deeper and deeper. The deepest inversion we've seen since, I think, 1981.
Right.
October 1981. Right now, yields on a 10-year unchanged at 353.31. Yields come back in a little bit by a couple of basis points, Tom. 434.74 on a US 2-year.
Ian Lingen at BMO again talking about a possibility to a negative 100 basis points. It hasn't been seen since, I think, biblical times, and we'll have to see on that within the recession screen. We come to you today with a lot of humility. John Farrell, Lisa Bramwitz, and I know that oil is the toughest commodity to call. There's all sorts of academic research that shows that. Yesterday we had on Edward Morse of Citigroup with a huge political, economic standpoint on hydrocarbons. And today, as acute, Francisco Blanch joins us, head of global commodities and derivatives research at Bank of America. Francisco, you were the first one out that I knew to model $100 a barrel. You made global headlines with it. You were right. Up we went, and then down we came on, I'm going to say, a dearth of demand. Christopher Rohn was just on, the technical analyst, and says the spot market for oil is behaving differently than the futures market for oil. Explain in Greek what that means.
Well, you want me to use Vegas and deltas in the process, Tom? Maybe not, right? Let me just say it in plain English. We have essentially very low speculative interest. Essentially, all the macro players have been selling oil on the back of recession fears. Some of the comments that you were just making before we went on the oil segment. Also, we've seen a dearth of liquidity. Liquidity is falling very quickly in the forward markets, and then I think beyond that, the physical market's been actually relatively more supported, although that's changing a bit too, because it turns out that the Russian supply disruption we were all expecting on the back of the EU sanctions hasn't really come through as expected, and maybe we won't be losing as much Russian oil after all.
Long ago and far away, Lisa Abramowitz put 2 kids through school speculating on oil when it went down under zero. There was that huge shock of 18 months ago, 2 years ago, and we kid her that she had 2 barrels of oil in her living room on delivery. Are we going to get the same spring here? Do we have a possibility of seeing 70 West Texas Intermediate become 95 or 100 West Texas Intermediate in a cup of coffee?
I'm afraid so. I think we have a very springy, I think you use a great word there, springy oil market because inventories remain quite low, spare capacity is tight, and if you look at the 3 key drivers of oil prices heading into 2023, they're clearly, in my view, whatever happens to OPEC plus Russia, whatever happens to China reopening, and the third one being the Fed pivot. And the way I think about each one of those is, if you look at our 2023 numbers, all the demand growth that we forecast for next year is coming from emerging markets, with China being 50% of that and India being about 20%. So we need emerging markets to come back strong. And it's still a little early, it's still a little unclear how China is going to make a comeback. And it may be a different comeback than the one that we saw in the U.S. and in Europe, particularly if the reopening is one of fits and starts, partly because I think the Chinese population has not really been much exposed to COVID. We talk about the post-COVID world in Europe and the U.S., but really China hasn't had COVID broadly disseminated yet to the extent that we've seen it in most other countries in the world. And so that's number one. Number two is really Russia, OPEC. How does that play out? How much oil do we lose from Russia? And how much oil does OPEC plus actually take out of the market? And then the third one really being the Fed tightening policy, and which at the moment we have OECD economies essentially growing zero next year. But of course, if U.S. Fed fund rates go to 6%, 7%, that could become negative pretty quickly here. And that's another big uncertainty and part of the reason oil prices have been falling in recent days.
So how much do you think that they could rise? I know that you have a target of perhaps $100 for WTI and $94 for Brent. How do we get there, given all of what you talk about, given that we already are seeing some fits and starts with respect to a China reopening, and it hasn't really caused the price to go up that much?
Again, I think the macro picture is pretty gloomy here, and that's part of the reason prices have come down. But I think it's a bit of a different environment to prior pullbacks in oil prices. First, we think there's a put that will be triggered. I mean, OPEC just had their meeting on Sunday, decided to roll over the cuts. But remember, the announced cuts were 2 million barrels a day. Nobody expected OPEC to implement a 2 million barrel a day cut. They could actually go and do that. They could actually implement a deeper cut. And also, we're going to see WTI prices entering the range at which the U.S. government will start filling, or refilling rather, the strategic petroleum reserve. I remember that number that was put out by the White House was $72 a barrel on WTI. Yeah. So we're getting close to the point where we might see those triggers providing support to prices here. So it's a bit of a different to the environment to the 2020 world where prices just cratered on the back of a collapse in demand.
Can you elaborate on that? Because this has been one of the big question marks. If the U.S. has said $72 a barrel was the time they'd start buying, and one of the big drivers of the decline in oil prices has been the release of the Strategic Petroleum Reserve, how much is that going to cause prices to rise? Are we almost there yet where this administration ought to start buying based on what they've said, and that will actually drive prices much higher perhaps in the short term?
Well, again, I'm just going by what the White House communique was a couple months ago. They're saying they're going to be buying oil as soon as we get below the $72 threshold. And the balance could change pretty dramatically here. We could see an extra 500,000 barrels a day of demand from the U.S. Strategic Petroleum Reserve. Remember that you need to probably put in 150 to 200 million barrels back in store. That's, again, that takes a whole year of buying 500,000 barrels a day. Right? I mean, that's simple math there, right? So you could see a pretty meaningful swing in balances in that regard. You could also see heading into 2023, China reopening, picking up momentum. even if the first 2, 3, 4 months could be a little patchy. And then, of course, I think the sanctions on Russian petroleum products, which kick in on February 5, are certainly a much bigger deal than the sanctions on Russian crude, which have turned out to be a lot to do about nothing, really.
What do you make? You mentioned the Xi Jinping meeting in Saudi Arabia. Well, how does that affect the dynamic of the oil picture, just given the sense that there seems to be an ongoing and public display of increased closeness there?
Well, I think that's only a natural development of the bilateral trade relationship between Saudi Arabia and China, which has changed dramatically since the advent of U.S. shale. Remember, the U.S. is now a net exporter of energy. We've argued the U.S. was going to be energy independent for the last 10 years, but now we're arguing the U.S. is going to be energy dominant. So in some ways, the U.S. is a competitor to Saudi Arabia in the energy space. And I think in that regard, the trade with between Riyadh and Beijing has really picked up pretty dramatically. So that I think is just a natural change of commercial relationships.
Maria from Brussels emails in and says, "Can Francisco make the kick from 12 yards out?" He's in Madrid.
He probably could.
He probably had a tough day yesterday.
He probably could. That was just brutal yesterday.
Yeah,
that was some of the worst penalties.
Francisco's in Madrid, and I'm sure the city must be gloomy.
Francisco, do you want to weigh in on that?
Yeah, it wasn't a happy day yesterday, I have to say. The team just kept passing the ball without really the Spanish team without really scoring. So it was a little disappointing. And yeah, mood's a little gloomy here. You can see the background. The sun hasn't come out yet. It may not come out for a couple more days.
Does Moynihan know you're in Madrid? I mean, he's talking about expense control, Francisco. How did this happen?
You causing trouble now.
I'm causing trouble. I mean, this is great. It's like Pharaoh and Cutter.
Just run, Francisco.
Yeah, you don't have to try.
I think, look, I mean, we have an office here. We have about.
There we go.
We have an office. It was an empty office when I got here, the one I got. So I don't think it's. I'm actually beefing up expenses here. Right.
There we go. Thank you,
Francisco. Wonderful, sir. Thank you very much, Francisco Blanche there of Bank of America. These guys in crude, I think, have the hardest job.
On the street. Absolutely, no question.
I think we often say, if you want to make a fool out of someone, ask them to predict the crude price year end, because this one has been tough.
And the academics and the differential between an Ed Morris with huge Princeton politics and Francisco with a wonderful European sense to it, and Jeff Curry, the microeconomist from Chicago, you get a really different tone from each of them. And there's others as well. Amrita Sen, I worship.
Energy aspects. She's great too. Do you want a range for next year on a 10-year Treasury yield? I'm going to bring you two calls. Steve Major of HSBC just published. Okay.
From where? Qatar?
No, I don't actually know. I'll try and find out. Maybe he is
Probably
watching the
Hong
football. 250 for year-end 23 on a 10-year. 250. That's Steve's call for next year. Okay. Eric Nelson of Wells Fargo yesterday.
You had him on yesterday.
475, 425 to 475, year-end 23 on a 10-year. And Eric says one of our highest conviction views heading into 23 is that a US 10-year yield of 350 is simply too low. That's the range right now. So you've got HSBC saying 250 year-end 23, and you've got Wells Fargo saying potentially 475. At least going into next year. I mean, can that get any wider?
We don't understand inflation. Nobody understands the path of inflation. Nobody understands the path of growth. And the gap here really highlights just how much uncertainty there is right now.
A crazy time. Crazy. Equity futures right now.
Absolutely original.
Down 2/10. Your yield on a 10-year, 353.49 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Democratic Senator Raphael Warnock has turned back Republican Herschel Walker in Georgia's runoff election. Warnock was reelected with a little more than 51% of the vote. His victory will give Democrats a 51-49 edge in the Senate, making it easier to legislate. Walker had been backed by former President Trump. China is retreating from the wide-ranging COVID-0 policy that it blamed for damaging the economy. Beijing will now allow some people to quarantine at home instead of in centralized camps. It's also scrapping virus tests to enter public venues. COVID-0 pushed down consumer and business confidence and left people stuck in a cycle of outbreaks and lockdowns. Saudi Arabia rolling out the red carpet for Xi Jinping today. The Chinese leader will visit the kingdom for several days and will take part in a regional summit with Arab leaders. According to the Saudi news agency, Xi is promising agreements worth some $30 billion. The trip comes 2 months after the Saudis snubbed President Biden's pleas for oil. Shares of GSK and Sanofi are surging today. A U.S. judge rejected scientific evidence behind claims that the heartburn drug Zantac can cause cancer. That means the drug makers don't have to face more than 5,000 lawsuits. A group of plaintiffs' lawyers say they'll appeal. And Apple may be cruising along with its CarPlay technology, but the tech giant tapping the brakes on plans for its self-driving car. Sources tell Bloomberg the company has postponed the future electric vehicle's launch date by about a year to 2026. Apple is planning a new design that will include a steering wheel and pedals and only support full autonomous capabilities on highways. The price tag, just under $100,000. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news, you will get insight into